Hi guys, it's Justin here, Trader 187. I've had a lot of people contact me telling me that they're stuck when it comes to trading and technical analysis. They don't know where to begin. There's a lot of videos online or a lot of people calling themselves gurus, but when they're actually following their teachings, they're not learning anything or can't actually apply what they've learned off YouTube or these other people to real life trading. So because of that, I thought that I'd save a lot of people the hassle and help people out, and do that by offering people this workshop. So in this workshop I will be covering what forex trading is and how technical analysis can help you in trading. I'll be showing you how to properly use Metatrader 4 using the chart setup, templates and profiles. This makes your trading a lot easier and helps you to be a lot more organized when it comes to trading. I will show you how to correctly identify support and resistance, and how to allow support and resistance to help you make trading decisions. I will show you market trends, show you how to use moving averages, the Parabolic SAR. I'll show you how to enter trades and exit trades, and also modifying current trades that you're actually in. I'll show you how to correctly draw trend lines and how they can help you. I will show you key candlestick patterns, or candlestick formations as they're also known as. They're the same thing. I'll also be covering risk management, the RSI, which is the relative strength index, covering divergence within that, the MACD, which is moving average convergence divergence. That's another technical indicator. We'll be covering Fibonacci, volume indicators, and then finally towards the end I'll show you how to correctly develop a trading strategy based on technical tools. Also show you how to test the strategy correctly and how to optimize the trading strategy, again because trading strategies is the key thing when it comes to trading, and without a solid trading strategy there's no way that you can be consistently profitable. However, you also need correct risk management, which is a key factor, and we will be covering that within the trading strategy and within this workshop. So by the end of this workshop you will have a great understanding of trading, and will be able to immediately apply all that is learned within this workshop into real life trading. So after this workshop that I present you today, you'll be able to immediately apply it to all your current tradings that you're doing now, and will definitely help you on the journey to becoming a more profitable trader. And I'm sure that you'll be grateful for that, as that's what people want to do, become profitable traders. So first off, we'll go on back onto the trading platform that you can see here. And firstly, to explain what trading is, there's different types of trading, whether it's forex, which is also known as foreign exchange. There's the stock market, which is like Google, Facebook, Nike, Amazon. That's companies. That's the stock market. So the stock market is the trading of companies. The forex, foreign exchange market, is the trading of currencies. There's also commodity trading, which is oil, gold, food. So that's commodities. And there's also the biggest trend right now, which is cryptocurrency, which is things like Bitcoin and that sort of thing. So the technical analysis that we'll be covering today, and all the technical tools in trading, can be applied to all forms of trading, whether it be foreign exchange, forex, stock market, commodities, or cryptocurrency. However, what I'll be covering most, and what I'll be actually analyzing on, is the foreign exchange market. But that's not a problem, because again, what I will be covering in this workshop can be used and applied on all other types of trading, whether it be commodities, stocks, or cryptocurrencies. So people ask, how can technical analysis help you to make your trading decisions? The way that technical analysis actually helps is, firstly, technical analysis is the use of past market data to help you predict future market trend direction. So if you're able to analyze and use technical tools to help you predict the likelihood of trend direction, it enables you to sort of help you predict the future to a certain extent, which will give your trading an edge so you'll be a lot more likely to make profit and make consistent profits as well. So also, in order to become a profitable trader, you do need to know how to use your technical tools correctly and in a way that enables you to sort of string them together and develop a trading strategy. A trading strategy is essentially a recipe that you follow in order to make consistent profits within the market. So with that, but we'll also cover how to create a trading strategy towards the later parts of the workshop. But now, the first thing we'll do on Metatrader 4 MT4 is chart setup. So we'll go on to our trading platform. I'll just clear this now so that you can see. So we're starting at the same place. What we'll do is go to this here, which is called Market Watch. Click on Market Watch. You can scroll down and we'll start with Euro USD. There's two ways. You can either click left click and drag onto the blank space, you can see it there, or you can right click and press chart window and the same thing happens. So now that we've got this chart on here, we'll close the market window. You can either X or you can just click the Market Watch again and it will close it. So we'll maximize this chart. We'll right click, press properties, because so again what we'll do, we'll right click, press properties, and we'll, instead of a bar chart, we'll press candlesticks, click off these, show ask line, show period separators. We'll remove this grid off here. We'll go to colors now, and how I like my charts to look is a background I like to be white, foreground black, grid black, bar up black, bar down black, bull candle I like to have lime green, bear candle red, line graph black, volumes black, ask line I like to have dark grey, and stop levels grey. Once I've done that, now I can press OK. As you can see, it still looks a bit funny, but all we need to do is go up here to this zoom button, press it once, you can see the candlesticks now, press it another time, you can see them a lot better. You can zoom in as much as you want, but I prefer to have mine like this or just like this. And on a 1 hour chart, these dotted lines here represent 1 day. On a 4 hour chart, these dotted lines represent 1 week. So each candle is 4 hours, but each period, which is these dotted lines, represents 1 week. If it's daily, then they represent a month, and so on. But now what we do is we right click, go to template, save template, and you will call it what you like. I like to call mine blank charts. I already have one named that, but it's just, you press save. If you'd like to replace it, press yes. And now what this means is, you can now minimize this. What this means is, if you was to ever add another chart onto your trading background, you can actually change it a lot quicker. So that being said, you can do GBP USD, drag and drop. You can now close this. You can right click, press template, blank charts, and you can see that the chart has already been changed. You can change the time frame as well, whether it's 30 minutes, 15 minutes, or daily, it doesn't matter. And I'll show you one more time. Market Watch, Euro GBP, right click onto the chart, press templates, go across to blank charts, and you can see that the chart has been updated. So that's how you set up your templates for your charts, for blank charts. So now that we've set up the charts, the next thing to do is to show you how to, when we've done your templates, the next thing to do is show you how to set up the charts for your profiles. So we'll go back onto our platform, And what we'll do, I like to have four currency pairs, four charts, sorry, on one profile. So I'll drag and drop another. At the minute, it doesn't matter that all of these charts are different. You can press window, you can tile horizontally, so it looks like this. We'll right click on this one, template, blank charts, so you can see they all look the same. Or you can tile vertically, so it look like this. Or my favorite way that I like to do is to do it manually, so that I can actually see the chart a lot better. You can make the charts you can make them a lot neater in your own time, but I'm just quickly showing you how to actually do it. And what I like to do is make sure that on one specific profile, I will make sure that all of the charts on this profile are the same charts. So in this instance, we'll make sure that all of the charts are Euro USD. So we'll go to Market Watch and we'll drag and drop Euro USD onto this one here. So it's changed. You can see it's changed, and the same needs to happen up here. We'll change it from Euro GP to Euro USD. You can see that's changed. The reason you can have four different charts is so that you can have 4 different time frames on the same currency pair. So for instance, the top left can be a daily, the top right can be a 4-hour, the bottom left can be a 30-minute or 1 hour, and the bottom right can be a 15-minute or 5-minute. It's totally up to you what sort of time frame you like to have. It's just up to preference. Once we've done this now, you can see that this is Euro USD. What we'll call this profile is Euro USD. So we'll click down here where it says default, just left click, press save profile as, and we'll call this Euro USD. Press OK. So now that template is saved. But what we'll also do is create another template so you click on this Euro USD, or down here again, press save profile as, and we'll call this one GBP USD. Press OK. But as you can see that the Euro USD is still on all currency pairs, but we now want to change it to GBP on all currency pairs. So we'll click on Market Watch, click your GBP USD, and drag and drop GBP USD. You can see it change on all of them. We change it on this one too, and now you can see that GBP is now on all currency pairs. So now you can easily switch between your currency pairs very easily without having to drag and drop or lose all of your data. So an example of this is, for example, if you was to do a trend line on the daily chart, you may have a rectangle on this chart, you may have Fibonacci on this chart. Again, I'm not doing this in any specific way, I'm just showing you that any analysis that you do on your profile will be saved, and you can go back to and change between other profiles too. And on this one we can have a couple of horizontal lines, and when we click on the bottom and click Euro USD, you can see that Euro USD is here. But now we'll do the same sort of thing, so that you can see that profiles do actually save what you put on there. So I'll put a couple of green boxes on this one, a couple of horizontal lines, and you can even change the color of this. So now you can see that any analysis that you did actually, this is not proper analysis. I'm just quickly showing you how to set up profiles and how it can enable you to be a lot more organized when it comes to trading. So any analysis that you do on Euro USD, you can do on these charts here, and it will be saved on your profile. But if you would like to change to another currency pair, for instance the one that we just did, which is GBP USD, you just click down here, then click on GBP USD, and you can see that we're back on GBP USD, and the analysis is still on there. And we go back to Euro USD, and the analysis is still there. So showing you how to go through Metatrader 4 and save the profiles correctly. It's a big thing. It helps you be more organized, and will make your trading a lot easier to manage. Also, if you cannot see this rectangle on here, all you need to do is go to the left hand side of the cursor, right click, press customize. On mine it's already there, but I'll remove it. You can see that it's gone. So all you need to do is look at the left, go down to rectangle, press insert, and now you can see that it's back there. And if you'd like to use it, you just click it and draw it there. So that's now showing you how to set up market profiles, and we just did, and you can do it for a number of currency pairs or any amount of profiles you like to do. There's no limit, but again, it helps you to be a lot more organized and keep your analysis in the right places when it comes to trading. Now the next thing we'll be covering is support and resistance. So we'll go over to our brokerage, and one of the main things is support and resistance is often drawn as a straight line, but however, support and resistance is actually a level. But now I'll show you this. So we click on market watch, drag and drop, right click, template, blank charts, maximize the chart. We'll find the support and resistance on a 4-hour chart, although you can do it on any time frame you like. And for instance, I'll show you how to, at the minute we're currently in a level of support. I'll show you that by this candlestick pattern here. You can see it appears to be slightly a morning star. You can see there's nearly a spinning top here, followed by the larger candlestick, but you can see that this is clearly a level of support. So we'll mark this out. So instead of just drawing one line, you can see that I'm going to draw the support as an area. So in this whole area is a level of support. I'll get the rectangle so I can mark out this area better, but I'll double click, you right click on the dot, whether it's this dot here, that dot in the middle, or that dot on the side. Rectangle properties, click on style, change the color. I'll make it pale green because I'm representing support, and I'll drag this box across. But now, so you can see a bit further across, I'll press this here, which is chart shift, so you can see a bit further across. So you can see that the level that we've marked out from this area here has been stretched across. You can see that price was up here, then it retraced back down. You can see that price nearly went into our level of support. It was very close, but as you can see, once it got close to this level, the buyers then pushed the price back up. You can see that when price entered this level here, there's some bullish candlestick formations and price did go up slightly, but we're currently hanging on in the level of support. So that's one area we've drawn here. Another example that I can see now is a level of support here. You can see this morning star pattern. So we'll get one horizontal line, draw that at the low there, and I'll draw this at the close of this engulfing there, and I'll get the rectangle and I'll highlight this. And as you can see, when price was in this area, you can see that price went up but then retraced back down slightly, and you can see that this pin bar here did enter the level of support that we marked out, and then price went up. So you can see that if you did enter on this pin bar because it entered your level of support that was previously marked out, you could have gained over 340 pips. And how that would work is, what you'd say is, you've marked out your level of support or resistance. In this case, it's level of support. So I'll go back over here. So for instance, we've marked out a level of support here. You can see that price is hovering above the level of support, but you will say if price re-enters my level of support, I will look for bullish candlestick patterns. In this instance, you can see a hammer, aka a hanging man, and you will look for bullish signs. Once you've actually seen the bullish signs, you can see that price then actually shot back up, and carried on going. So I've shown you a couple of examples of support. Now I'm going to look for an example of resistance. I'll make this small. You can also find support and resistance on any currency pair. I don't want you to think it's Euro USD specific. It's actually for any currency pair. So now I'll drag and drop GBP USD. Right click. Template blank charts. So now I'm looking for resistance that I can draw for you. So as you can see here, you can see that this is a bearish engulfing candlestick pattern. I will now draw the horizontal line at the high and at the close. But I'll double click, right click, rectangle properties. I'll make this box pink so that you can see it represents resistance, and you can see that the level of resistance has been drawn. And how this would work is, for instance, you can see that the level of resistance was there, price actually fell from this level. You can see that price retested this level and found resistance and went back down. And it could be in your strategy that if price, because for example we're hovering at this price here, for example, you can say that if price does re-enter my level of resistance, I will look for bearish signals and look for opportunities to sell. You can see that when price does actually reach this level, you can see that there's a small, of evening star candlestick pattern here. You can see these 3 candlesticks. So if you actually did enter, then you could have potentially gained just over 400 pips based on drawing out your support and resistance levels. But now I'd like to show you an example another example, sorry. And there's endless examples of support and resistance. There's one here. You can see that there's a spinning top followed by a bullish candle, which is essentially a morning star. So I've just marked out this level here. I'll get the rectangle so you can see it a lot easier. I'll right click, rectangle, make it pale green, go across, and as you can see, price was pushed up by the buyers in the support level. You can see that at this level here, price nearly touched the support level but went back up. But as you can see around this level, once price did enter this level, you can see that there's bullish candlestick patterns here. There's a hammer and bullish engulfing, and you can see that the market went up, and you can see that price actually retested this level and continued up. So if you entered around here, you could have gained over 300 pips. I'd now like to find an example of when support becomes resistance or resistance becomes support. So right click, template, blank charts, 4-hour chart. And also when you can't actually scroll across, or when you try to scroll across and the chart keeps moving you back to this position, all you actually need to do is click on here, which is auto scroll, and you'll be able to scroll back. So now I'm looking for an example of where support becomes resistance becomes support, sorry. And as you can see here, we have a bearish engulfing candle. So I'll draw the horizontal level here at the bearish engulfing level. I'll get the rectangle, and because this is resistance here, I will right click and make this pink. And how it would work again is you'd mark out your resistance level. You'd say if price re-enters my level of resistance, I will look for bearish candlestick patterns. As you can see, there's a bearish engulfing pattern here, and price is pushed back down. You can see that you could have made potentially over 150 pips. But what I wanted to show you is how price shows support, resistance becomes support. you can see that price is hovering below the level of resistance. It reaches it at this level, but sellers or resistance push the price back down. However, you can see that price broke through the level of resistance. However, it found the level of support within the resistance. So what was previously resistance here, you can see that price actually found support. So I'll now draw this level as a line of support. So I'll right click and make this pale green. So this is a perfect example of when what was once resistance acted as resistance here, here, and here slightly, was broken through and actually acted as a level of support, because within this area you can see that as price retraced with this bullish candle here, there's a slight sign of support, but within here you can see that there's a morning star candlestick pattern and price goes up, and you can actually see there's a pin bar followed by a strong bullish candle, which is a sign of bullish candlestick, which is a sign of resistance becoming support. So I'll go back on here, and this, you can see that I did draw the level of support which we're currently in there. You can see that there's a level of support here, and if you click on GBP USD, you can actually see there's a level of support here also, and there's a level of resistance. So now we've quickly covered level of support and resistance. We'll move on again. Now the next thing that we'll cover is trend. So we'll go back onto our platform. I'll get a new chart now. Make this large, right click. So now I'm going to show you market trend. There's actually three types of trend. There's uptrends, downtrends, and sideways trends. So we'll start off with the uptrend, Euro USD 1 hour chart. An uptrend is defined as higher highs and higher lows. So I will mark these out with the, so we'll start off with this low here. This is one low, so this is a low. This low here is higher than this low, and again there, and again there. So an uptrend is defined as higher lows. I'll mark out these lows with the horizontal line also. That's one low, 2, 3, and 4. I'll also mark out the higher high. So that's one high, 2, 'So now I'll mark out the higher high with the horizontal line. I'll do this a different color actually. Make it a darker green. And I'll also mark out the highs, the horizontal line, but I'll make this line blue. There and there. So an uptrend is defined as higher lows. The higher lows are represented as the lighter green boxes, followed by the red lines. So that's 1, 2, 3, 4. So higher lows, and also higher highs. The higher highs are represented by the darker green boxes, followed by the blue horizontal lines. 1, 2, 3, 4. So an easy definition of what is an uptrend. An uptrend is higher highs, which is 1, 2, 3, 4, and higher lows, which is 1, 2, 3, 4. That's an example of an uptrend: higher highs and higher lows. Now I'll show an example of a downtrend. A downtrend is defined as lower highs and lower lows. So now I'll mark out these, but instead I'll mark out these in a pink color. So that's one high, 2, 3, 4. So a downtrend is higher. Oh, sorry, a downtrend is lower highs. I'll also do the horizontal line. I'll start off these being red. So these are the lower highs. 1, 2, 3, 4, 5. I'll also mark out the lower lows using the horizontal, using the rectangle again, but instead I'll make this a darker red. One, two, and I will use a blue horizontal line so that you can see it. So a downtrend is represented as lower highs, which are here, highlighted here in the pink with the red line, and lower lows, which is represented as the dark red, sorry. So that's a downtrend. Downtrend is lower highs and lower lows. And now I'll show you a sideways trend, and an example of a sideways trend is here. This is when the market actually is neither in an uptrend nor a downtrend. It's actually just moving sideways. That's sideways market, aka ranging market, when price is just within that area. So I'll highlight this. Double click, and I'll make this blue. So this, make it a lighter blue for you guys. So this is a sideways trend. But now I'll quickly go through them again. So this is an uptrend. Remember, an uptrend is higher highs and higher lows. A downtrend is lower highs and lower lows. And then finally, a sideways trend is just when the market moves sideways and just ranges, so it's not in a trend. But there's three trends. There's sideways trend, upwards trend, and downwards trend. I've just shown you them. So just to conclude, there are three trends, which are uptrends with higher highs and higher lows, downtrends with lower highs and lower lows, and sideways trends, aka ranging markets or channeling. It's good to, the way that you can use this technical tool of support resistance, or sorry, of trend to help determine trading decisions, is by, for example, if you are in a downtrend, then only take sell opportunities, and if you are in an uptrend, only take buying opportunities by trading with the trend, you get to reduce the amount of losing trades you have and increase the amount of profitable trades you have. As I'm sure you may have heard, the trend is your friend until the end. But while you do know the trend, you should always trade with the trend, as counter trend trading is very aggressive trading, and it has a higher percentage of you making losing trades, which is what you don't want to do. So now the next thing that we'll be covering is moving averages. So now how you apply moving averages to the chart is quite simple. All you do is press insert, indicators, trend, moving average, and we will set the first one will be 40 period moving average with simple. I like mine to be red. Okay, so this is the red. This is a 40 simple moving average, and I add another moving average to this. So we insert, indicators, trend, moving average, and the period on this one will be 10 period moving average, and I have this on an exponential, and I will make this color blue. So you can see the 10 moving average is the blue blue line, and the 40 moving average is the red line. A way for you to identify which moving average is which is you just hover over the moving average and it will say 40, which you can see there, or you can hover over this one and it will say 10. You can also change them by just right clicking on the moving average properties. You can change this number to 20 and it changes, but I'll change it back to 10. You can also change it to thickness, so you can have it very thick like that. I'll just have it back to normal. So in this example I'm using the 10 and the 40 moving average. So a thing that I said to you just now is that the trend is your friend and you should trade with the trend. So what you use the moving averages to help you determine market trend. The easiest way to explain that is if the fast moving average is above the slow moving average, then you are in an uptrend, or if the fast moving average is below the slow moving average, you are in a downtrend. In this instance, the blue moving average is the faster moving average, as it has a lower period, which is 10. So this is the faster moving average, and the slow moving average is the red moving average here, which is the 40 moving average. So now I'll show you how to determine trend using two moving averages. This is done by the blue line being below the red line. So in this period here, I'll mark this out using a vertical line. I'll make blue. I'll make it a bit thicker so you can see it. So at this point here, where the blue line has crossed below the red moving average, sorry, oh man, change this color. At this period here, where the blue moving average has crossed below the red moving average, we are in a downtrend, as you can clearly blatantly see. And the downtrend ends when the blue moving average crosses above the red moving average, which is down here. So in this period from here to here, from this green line to this green line, we are in a downtrend, and we are in an uptrend when the blue moving average, or the faster moving average, aka the 10 period moving average, is above the 40 moving average, which is in red. So in this period from here to here, we are in an uptrend, but as the blue goes back below the red, we are in a downtrend. The reason there's a lot of up and down is because that's how markets move, but also we are on a 1 hour chart. I'll just get rid of these vertical lines now, and I will go to a 4 hour chart. As you can see on a 4-hour chart, there's a lot less signals. Whereas if you was to go on a 1-minute chart, you can a 5-minute chart, you can see that the blue crosses above and below the red very many times compared to on a 4-hour chart. And so on, if it was on a daily chart, you get even less crosses again. But for this purpose, we'll stay on the 4-hour chart as it shows enough examples. So for example, in this period here, when the blue moving average crosses above the red moving average, which is at this point here where the green vertical line is drawn, we are now in an uptrend, and where the blue moving average then crosses below the red moving average, we are in a downtrend. So to show this uptrend, I will highlight this in a pale green box. Let's change the color. So this pale green box shows the point at which the blue line crosses above the blue moving average, crosses above the red moving average, and where the blue moving average crosses below the red moving average. So this period here will show that we are in an uptrend on the 4-hour time frame, which is up there. The way that you can use this to help yourself is if you know that you are in an uptrend on a 4-hour time frame, then you know that you can only take buy opportunities if you would like to trade with the trend, which I do recommend. So a way that you can do this is if you're in an uptrend on the 4-hour chart, but you're looking for signals on a 1-hour chart, then that means that you will look for only buy opportunities on a lower time frame. And I'll just show you how that works now. So I'll add another time frame chart, which is a 1-hour time frame GBP USD. Put a blank chart. And for the period of so for instance, from the 6th of March until the 29th of March, you are in an uptrend on a 4-hour time frame. As you can see, the blue moving average, aka the 10 moving average, is above the 40 moving average, which would mean that on the 1-hour chart you'd only be looking for buy signals. So for instance, if we are around about here, which is around the, say, the 15th of April of March, the 15th of March, and around the 15th of March in the 1-hour time frame, because you know that you are in an uptrend on the 4-hour chart and it is part of your trading strategy to trade with the trend, i.e. an uptrend, so that means you would only be taking buy opportunities. It means on a 1-hour time frame you'll be looking for buy opportunities. So you'll be looking for bullish candlestick formations or patterns, or RSI divergence, so showing bullish divergence or that sort of thing, or trend line touches. So now I'll show you when we're in a downtrend. An example of a downtrend would be an easier example here is where the blue line crosses below the blue moving average, crosses below the red moving average, aka the 10 moving average crosses below the 40 moving average, and the downtrend lasts until the blue moving average crosses back above the red moving average. So this period from this green line here to this green line here will indicate that we are in a downtrend, and I will highlight this with a pink vertical box, so you can see that here when we use the 2 moving averages being the 10 moving average and the 40 period moving average, we are in a downtrend. So Using two moving averages is a great way to help you determine if you are in an uptrend or a downtrend, because if it's part of your trading strategy that you'd like to trade with the trend of the market on a larger time frame, then you'll use these two moving averages to do so. So all you would do is place the two moving averages, whether they're 10 moving average and 40 moving average, or 10 and 20, 15 and 5. It's totally up to you what you may have. But you'd use two moving averages, one with a higher period and one with a lower period. And what you would do, you'll wait for the moving average with the lower period to cross above the larger period moving average to indicate an uptrend, or you'll wait for the lower period moving average to cross below the larger period moving average to indicate signs of a downtrend. So again, moving averages are lagging indicators, but they're a great tool to help you determine which trend direction the market is heading. And the way it can be used again here is to show where we currently are. Price is currently around this level, but as you can see, the slower moving average, the faster moving average, which is the 10 EMA exponential moving average, is below the 40 simple moving average. This indicates that the GBP USD market on a 4-hour time frame, based on using our two moving average crossover, that we are in a downtrend. So I'll now show another example of trend using the moving averages. So at first I'll just backspace and delete all the previous analysis on there. And again, you can use all these technical analysis on any currency pair, and literally all you'll do is apply the two moving averages, the fast and the slow moving average being the 10 moving average and the 40 moving average. And if the 10 is below the 40, then you are in a downtrend, or if the 10 is above the 40, you are in an uptrend. So this example here, we are in a downtrend. In Euro USD 4-hour chart, we are in a downtrend because the 10 is below the 40. Euro GBP, here we are in an uptrend, even though price is below the moving average. We're looking at the blue moving average, or the 10 moving average, is still above the 40 moving average, so we're still in an uptrend. We'll do two more. USD JPY, this is in a clear uptrend because the 10 moving average is above the 40 moving average. And then finally we'll do AUD USD, and we are in a downtrend because the 10 moving average is below the 40 moving average. Again, moving averages are a lagging indicator, but they're a great tool to help you to determine which trend the market is trading in. So again, if you are in a downtrend on the markets, then it's a good idea to trade with the trend and only look for sell opportunities. Whereas if the market that you're trading is in an uptrend, you should only be looking for sell opportunities, because the trend is your friend, and the best thing to do is to trade with the trend, as it's much safer and less risk. But you can also use the moving averages to take signals as well, but we'll get onto that at another stage throughout the workshop. The next thing that we're going to cover now is the Parabolic SAR. So a lot of you may not have heard of this technical tool, but it's a very simple tool to use. I'll show you how to apply this. It can be used on any currency pair as well. So what you do is let's make the chart big. You click on the chart, insert, indicators, trend, Parabolic SAR. Click on that, leave everything the same, reset, leave everything the same, press OK. At the minute you can't really see it on my chart, very faint dots, so I'll right click, Parabolic SAR, and I'll make my color black. I'll change this thickness to this thick, press OK. Now you can see these dots on my chart. So a great way that they're actually used is as a stop loss. So they help you to manage risk and also help you to lock in profit. What I mean by this is, for example, if we were to make a trade here and we for some reason we saw a sell opportunity and we'd like to sell at this price here, many people may not know where to put their stop loss, so they may put their stop loss. So sorry, this blue line will represent our entry price, and this red line here will represent our stop loss. So some people will put your stop loss there, or they may put it here, but you should actually put the stop loss at the high. So as some people may find this a bit difficult to do, based on them not actually knowing much about technical analysis, the Parabolic SAR can sort of act as a help for you in order for you to put the stop loss in the correct place. So wherever you make a trade, for example, even if you was to make a trade here at this line, at this level here, you'd put your stop loss at the first Parabolic SAR dot, which is there. So this is where you put your stop loss there in this situation. Or another situation you may have is you may have a sell opportunity at this level here where this blue line is, and you may not know where to put your stop loss, or you may think that you can put your stop loss here, but that's not a technically sound place. For stop loss positioning, your stop loss should always be in a technically sound place. So it should actually be here, and the reason it is there is because always put your stop loss at the first initial point at where the Parabolic SAR actually is. I'll show you another example for a buy opportunity. If you was to enter the market now, the line's blue. If you was to enter the market at this price, say we didn't know what happened next, if you was to enter the market at this price here and you didn't know where to put your stop loss because the stop loss is in red, and you may not have known where to put a stop loss. Some people may have put the stop loss here because they think it's okay, but this is not a technically sound place. Instead, all you have to do is put your stop loss at the point at which the Parabolic SAR first dot would be, and that's here. So here you can see that your stop loss will be in a technically sound place. And the way to show you this working in a live market, for example, is to show market is currently hovering around this level. I'll just use chart shift. It's currently hovering around this level, but if you was to enter the market at this exact price now, which it currently is, you don't know where to put your stop loss. All you do is put your stop loss at the first Parabolic SAR dot, which is there, and that is a technically sound place as it's at the low. So that's an example how to use the Parabolic SAR as a initial stop loss to help you manage risk. But also the Parabolic SAR is a great tool to help you to lock in profit when you are in trades. What I mean by that, for example, is some people you may have your trading strategy may have made you enter the market around this level here. I'll put this line again in blue. So you may have entered the market at this level here, and the market has continued to fall. However, your initial stop loss, based on your technical analysis, or what I've just mentioned to you about putting your stop loss in a technically sound place, your stop loss could be here. So for instance, if you're still currently in this trade and you've risked this much, which is 33 pips, but you've gained 225 pips, which is a very good risk to reward ratio, it would mean that you should lock in a great deal of your profit. So instead of having your stop loss up here and still having your trade at risk and still having 33 pips at risk, instead you should lock in profits. And how you do that, which is on our next step, is about modifying trades, is you will lock in profits. So you can use the Parabolic SAR I know you've probably heard of people saying about trailing stop losses, but instead you can apply the Parabolic SAR and you can move your stop loss to, it could be part of your strategy to say that you will move your stop loss 5 points away from the current Parabolic SAR, which is here. So you do 1, 2, 3, 4, 5, which is there. So you 1, 2, 3, 4, 5. So you move your stop loss to here, so you lock in the profit. I'll just put this back here. So for instance, this blue line again represents your entry price, and this red line here represents your initial stop loss. But because you have gained so much in profit from this trade, you should make sure that you're locking a great degree of profits, and trailing stop losses according to where the Parabolic SAR is positioned is a great way to help you lock in profit. For example, if you was in the trade, you'd as a new Parabolic SAR dot is formed, you'll move your stop loss to there, then you'll move it to here, then to here. So as the Parabolic SAR creates more dots, you are locking in more profit, and you're doing it gradually as well, which is a good thing, rather than doing it too soon and ending up being kicked out of the trade too soon, or doing it too late where you may not be able to cash out enough profit. This is a great way to make sure that you always lock in a decent amount of profit, and you're locking your profit strategically based on the Parabolic SAR. Because a lot of people have been in trades where they enter at this level here, they've made a great deal of profit from there to there, and instead what they do, instead of locking in profits, they decide to leave the trade as it is, and the market, even though they think the market will go down even further, what actually happens is the market actually bounces back up, and you end up losing your profits. So when it comes to trading and doing it properly and actually having a clear strategy, even though you have a clear enter strategy for entering trades, you also need a clear exit strategy and also a clear way of locking in profits. Again, the easiest way to do that is trading profits based on the Parabolic SAR, which we've just covered. So I hope that helps. So now the next thing that we're going to cover is trades. So this is trading, how to enter trades, how to exit trades, and also how to modify trades. Now I'll make this a blank chart again, and a way for you to enter trades there's a couple of ways for you to enter trades. You can click on the currency pair that you are trading. Again, I'm just going to enter trades now just so that you know how to enter trades. There's no strategy involved. I'm just showing you how to enter trades so that you can do it in your own time and you won't have any issues. All you'll do is click on the chart, press new order, and you can buy or sell straight away. So for instance, press buy. That means that we've just bought a trade, and you can see that it's there. You press this here, which is called the terminal, and you click on trade. When you're on trade, you can see that this is the trade, AUD USD. You can also see AUD USD there, and you can see this is the trade. And once the trade has actually been entered, I didn't enter the trade with a stop loss. I just showed you how to actually enter the trade, and you can close the trade by double clicking on it and pressing close. So you've closed the trade. So that's one way of entering trades. Another way is to click on market watch, and then as you can see, you click on the currency pair that you may like to trade. Again, the same ones there, which is AUD USD. You can right click and press new order, the same thing comes up, or you can double click and press buy or sell. It's totally up to you what you decide to do, but obviously your trading decision will be based upon your trading strategy, but we'll get to the trading strategy towards the end of the workshop. So that's how you enter trades. You can also sell trades as well by simply pressing sell, and then when you'd like to see how the trade's doing, click on the terminal. You can double click and press close, or you can right click and press close, or you can press X there and press close. So that's how you can enter trades. Again, I haven't, oh sorry, you just go to, if you press new order, you can also change the symbol here of which currency pair you'd like to trade, but that's unnecessary. The best way to do it is to click on the chart and then just press new order, and it will change up there. For example, if we change the background now, so we're on Euro USD, which you can see here. If we click on the chart and press new order, you'll see that now it says Euro USD. This here is called volume. This is to do with risk management and value per pip, but that's to do with our risk management, and we'll talk about that later on in the workshop. This here is to cover stop losses and where to put them, and sorry, the number at which you'll put your stop loss, but we'll cover that as well. And this is also for take profit. But now I quickly just showed you how to enter a trade, sorry, on MT4. So one of the key things about trading is managing risk, and I'll briefly cover this topic very briefly about managing risk while entering trades. But if we look here, we're on how to enter trades, but we'll later go on to risk management. Sorry about that. We're currently on how to enter trades, and I'm just covering a little bit about risk management in regards to stop losses, but the proper risk management section we'll come to shortly. So before you enter any trade, you should always have an idea where you'd like your stop loss to be. So again, I mentioned about the Parabolic SAR. I'll show you how it's a good tool. So you press insert, indicators, trend, Parabolic SAR, press OK. We're on a 4-hour chart, and after this, if this candle closes how it is now, then a new Parabolic SAR dot will have formed, and that's where you put your stop loss. In this instance, where the dot is, the Parabolic SAR is not there, it's not really helpful right now, so I'll just remove it. And you put your stop loss at the low of the candlestick, which is here, and I've used a horizontal line which shows up with price on the right hand side, so I can type that into my stop loss. So you click on the chart, press new order, and you'd like your stop loss to be the same number as this, so you press 1.21445, press buy now, and as you can see, we have entered the market. And if you press terminal, you can see that your stop loss is 1.21445, which is the level at which we wanted it to be there. You can actually modify your trade by double clicking on stop loss here, or SL. SL stands for stop loss, and you can change this number to whatever number you may like. You can have it a bit higher, and you can see that it changes, or you can manually do it. So say 50. You can see that the stop loss has actually changed. Or you can right click and press modify, and then you can change it back to normal, or back to what it was before, which is 21445, and press modify, and we're back to normal now. So that's the example to show you how to actually modify the trade, and this will show a good example now about managing risk. So we enter the market at this level, Our stop loss is originally here. This is very soon about changing your stop loss, but it's a good example to show. So we'll double click and we will move your stop loss to the entry price that we traded, which is this level here, which is at 1.21877, and press modify. So now your stop loss is at your entry point. Again, it's very soon to do, but I'm just showing you that you can actually modify your order at any time. All the trades that you've taken will be shown in your account history, so you can see them and you can see what's going on there. So you can see the first trade that we just made was a profit, the second was a loss, and this one became at a little bit of profit. But again, I'm not making these trades to make profits or losses. I'm simply making the trades so that I can show you how to enter trades, how to exit trades, and how to modify trades. So it's pretty straightforward once you've got your head around it, but I advise just taking loads of trades so that you get your head around it and you are familiar with making trades. Again, I'll show you how to make one more trade on GBP JPY. Drag and drop. I can press new order. For instance, if I'd like to buy at this level, the Parabolic SAR will work now. Insert, and this is where the dot is. If I'm going to buy at this level, you can use the first dot here or the first dot there. But again, this is no trading strategy at the minute. I'm just showing you how to enter trades and how the importance of entering a trade with your stop loss already in mind. So if you use this Parabolic SAR here, which is the start of a new one, you can get your horizontal line, put the horizontal line at the same level, click on the chart, press new order, and you want your stop loss number to be the same as this red line here. So it's going to be 151.951, and then you'll press buy and you press your terminal. So as you can see, you have entered the market GBP JPY, which is the same here. Your stop loss is the number that we set, 151.951, and you can see that we're currently in the trade. You can modify, the way for you to exit the trade is to either double click on the market, press close trade, or right click, press modify. Right click and press close order, or you can simply X on the trade. But me personally, I'll just double click and press close trade and press OK. So yep, that's an example of how you make trades using MT4. The next thing that we're going to cover now is trend lines and how to correctly draw trend lines, because that's a major thing. So click onto our currency pair. This. So trend lines are correctly drawn by at least you draw from one point to another point. So when you draw in a downwards trend line, so to represent a downtrend, the trend lines are drawn from the highs. So to draw a down, you'd never draw a downwards trend line at the lows. So it's never drawn at the lows. A downwards trend line is only drawn at the highs, and it's to at least 2 points. So you do one at the highest point, and the next point will be there at this level. As you can see, price, the trend line is touched there, and then you can see price reaches this level here, and the resistance kicks in, as this is a resistance trend line because we're in a downtrend, and it shows that once, because the trend line has been drawn from 2 points, ideally you would draw the trend line at 3 points, but 2 points works fine. And as you can see, once price falls down and then retraces back to this level, you can see that price finds a level of resistance and the sellers push the price back down. Price doesn't actually get to touch this trend line, although it's very close, perhaps 1 or 2 pips away. but as you can see, the resistance trend line is respected and price then falls from this part. You can see as price then reaches this trend line again, there is a level of resistance. However, price breaks free from this trend line. So that's an example of a resistance trend line. Again, you must remember never to draw a downwards trend line below. A downwards trend line can only be drawn from the highs. So another example is you draw it from this high to another high, which is there for these 2 points, that point there to this point here. And as you can see, price nearly touches this trend line here, but as you can see, there is a level of resistance and sellers are pushing the price down. But again, you must draw trend lines, you must draw resistance trend lines at the highs, from high to high. I will look for an example of an upwards trend line. You draw the upwards trend line from the lows. So remember, resistance trend lines are drawn from the highs, but upwards support trend lines are drawn from the lows, from low to low. So as you can see, the first point is this point here, the second point is here. So a way that you use this is, if you didn't know what already happened, you would draw a trend line from this point here to this point here, and it will be part of your strategy to say that if price reaches my trend line, my support trend line, then I'll look for opportunities to buy. You can see that once price did reach the trend line here, it did find a level of support and price went up, and you could have gained over 150 pips. Wow, you could have gained over nearly 350 pips just based on these trend line touches. And as you can see, price using the same trend line that we drew here based on these 2 points, you can go across and you can see that price did actually find the level of support at this area here, and you can see a bullish candlestick pattern, which is a pin bar followed by another bullish candlestick, and you can see that there was a level of support and price pushed up, and you could have gained over 150 pips. So that's another example of how trend lines can be used. On here, this is a resistance trend line. You draw it from to at least 2 points, and as you can see, this is one there, 2 there, 3 there. So again, if you didn't know what was happening and you've drawn your trend line of resistance for a downwards trend, and you're around this level here and you're not sure what's happening, you'd say if price reaches my trend line of resistance here, I will look for bearish opportunities to sell. And as you can see, once price did touch this trend line, you can see it has a bearish engulfing candlestick. Previous to this, there's a spinning top, which means it's an evening star candlestick pattern or candlestick formation, and an opportunity to sell. And you would have made, or you could have made, 100 pips. But also, what resistance, the same way support and resistance change their roles in general support and resistance, the same applies for support and resistance in trend lines, because this is a trend line of resistance that later becomes a trend line of support. So as you can see, this is a trend line of resistance. When price reaches at this level, price falls. When price reaches at this level, price falls, and the same here. However, price finally breaks through this level here, and you can see that the trend line is now broken. So this is an indication that it's a change of trend, and you're no longer in a downtrend, instead you're in an uptrend. So you can use trend lines to help you determine market trend, whether you are in an uptrend or a downtrend. But based on experience, I recommend using the moving average way of determining market trend, as it's much more simple and it's much more effective. That's based on my experience. But what was once resistance, which is here as a resistance trend line, later becomes support, which is there. So that's another example of how support can become resistance. I've already shown you this one here. And the way that trend lines can be shown, the way that you can use trend lines in actual live data now is, if I just click on this chart and I go to current price, I can see that I can draw a trend line from this high here to this high there, and I would say that if price, this at the minute, this is where price is currently, but I'd say if price reaches my trend line of resistance, I will look for opportunities to sell, as this is my trend line of resistance. You can also draw another trend line, which you could draw from this point here to that point there. You can say if price reaches this level, I'll look for opportunity to sell also. And you can also use trend lines on any currency pair. At the minute we're using it on Euro USD. You can use it on GBP JPY, and you draw a trend line from the low, these 2 points here. As you can see, price nearly touched the trend line, but you can clearly see that price did find a level of support around this area, which is also in line with being the trend line of support. So how this would help is if price then starts retracing and falling back to the trend line, you may say that you look for signs of bullish candlestick formations, and then look for signs to buy, so you can enter the market in a long position. Long position meaning a bullish position. But again, this is to show how to correctly draw trend lines. So when you are in an uptrend, you must draw a trend line at the bottom, so you draw a trend line at the lows. But when you are in a downtrend and you draw in a trend line for downtrend, then you must draw the trend line from the highs. So from this point you can see the first touch, the second touch, the third touch, it touches again here, fourth, fifth, and as you can see, price breaks there. So I'll actually highlight this for you. So this is where you draw the trend line from. Touches there, touches this high, this high, this high. So as you can see, there's 1, 2, 3, 4, 5 touches on this trend line. It's a clear sign of resistance. It's a clear trend line of resistance. But as you can see, once price broke through the trend line, it found the level of support. This is shown by this very large bullish engulfing candlestick pattern that I'll highlight now in green. Because what I showed you previously in the workshop on support and resistance is what was once support can become resistance, and what was once resistance can become support. In this instance, it's a great example that showing that the trend line of resistance, which was very well respected here, once price broke through this level, this same trend line of resistance then acted as a trend line of support. So how you would have worked with this is, for example, you've already drawn your trend line on 2 touches. You'd say if price reaches my trend line, I will look for bearish candlestick patterns. That is represented here as a inverted hammer followed by an engulfing pattern. As a whole, it's a bearish engulfing pattern, so it's a good opportunity to sell. And it would be it could be in your trading strategy to say that if you have a line of resistance, a trend line of resistance, you'll look for bearish candlestick patterns. As you can see here, it's a bearish engulfing candlestick pattern. You could have sold and made nearly 300 pips as price reached this level. There's no bearish candlestick pattern here, no key bearish candlestick pattern, although this is a dark cloud, but that's not a key candlestick pattern. I'll go on to the key candlestick pattern shortly as well throughout the workshop. You can see that price didn't actually get to touch the trend line of resistance here. The sellers got involved, and there was a level of resistance before this point, and price pushed down. But as you can see, once price pushed past and broke through this level, price was retracing. However, it found the level of support on the line of resistance, and you can see this by this very large bullish candle, which these two candles here are bullish engulfing candles, but we'll cover those very shortly throughout the workshop. And you can see that price found a level of support on the trend line of resistance. So again, this was previously a trend line of resistance here, but as you can see, once price broke through it, price then found support on the line that was resistance. And if you did enter this trade here, you could have potentially gained over 600 pips just based on you following your system of technical analysis and seeing that occasionally trend line resistance can become trend line support, or the other way around. So I hope this helps now. The next thing that we'll be covering is key candlestick patterns. The next thing that we'll be covering now is key candlestick patterns, or in other words, key candlestick formations. So I'll go onto the chart. So what these are here, as in these red and green things, these red and green things are called candlesticks. I'll zoom in now so you can see them even better. So the red ones means that they are bearish, and the green candlesticks means that they are bullish. You can change the color to whatever color you like to have, but for me, I prefer to have red and green. So with any candlestick, there's a few key factors. So for example, these long black lines here are called candle wicks. So you've got some candle wicks at the top of the candlestick, and there's some candle wicks at the bottom of the candlestick. The whole thing itself is called a candlestick, but the lines above it are called candle wicks, or the lines below it are called candle wicks also. Now the part that has a color, in this case it's a green color, this is called a candle body. And also the candle that has the red part here is called a candle body. So the red and green parts are called bodies, and the black lines themselves are called wicks. So candle wicks and candle bodies together make candlesticks. So the lower candlestick actually shows you let's go. This H4 means that each candlestick here is worth 4 hours worth of data. So that means in this 4 hour time period, this candle in particular here, the price when the 4 hour candle opened, it opened at this price here at the low of the candlestick body. So this is where the candlestick opened. The long black line represents, within these 4 hours, it represents that price went as low as the lowest point of the candle wick. However, it did not close down there, so price just went down there briefly within the 4 hour period and then went back up. The high of the candlestick, when you are looking at bullish candlesticks, because this is a green candlestick, this means that this is where the candlestick closed in the 4 hours. So the low of the candle body is where the candlestick opened. The low of the candle wick is the lowest point, the lowest price at which price reached. The highest point of the candle wick represents the highest price at which price reached within the 4 hour time period. However, the high of the candlestick body in this bullish candlestick here represents the price at which price closed the 4 hour candle and opened a new candle. So in essence, the candle opened at this level here, it went as low as this candle wick here, but price went as high as this candle wick here. However, price closed at the top of the candle body here. That's just the understandings of how candlesticks are. I can go into more detail, but for now I feel that this has covered it in the short period of time to cover our workshop. So again, These are candle wicks. That black line there is a candle wick. This black line here is a candle wick, and the solid section here is called the body. The same for the red. So the good thing about candle wicks, or candlesticks, sorry, is that through this data you get to see the highest point at which price reach and the lowest point at which price reach within the specific period of time. In this instance, it's 4 hours. If you go on to H1, aka a 1 hour chart, that means that each candlestick is worth 1 hour. If you go to 15 minutes, it means each candlestick is worth 15 minutes, and so on. D1 means each candlestick is worth a day. So if we're looking at the daily chart here, for this candle here, you can see that price opened at the high of this candle body here. Price reached as high as this candle here. It reached as low as this candle wick here. However, for the end of the day, price closed at this price here, which is the low of the candlestick body. But that's enough of the mechanics of the candlestick. Now I'll go on to the more important part and the easier to understand part, which is the candlestick formations and the candlestick patterns. So we'll cover a few key patterns and key candlesticks. Briefly, they're called the hammer, aka a pin bar, or an inverted hammer, or an inverted pin bar. Then there is bearish engulfing patterns and bullish engulfing patterns, or there is a spinning top or a doji star. So I'll start off by finding a hammer. This candlestick here, which has a long body and a long candle wick at the bottom and a short body, this is a hammer. Hammer, aka, I'll just write it here. Hammer or inverted. No, this. That's what this is. So this candlestick here, I'll just insert an arrow for you guys. So this candlestick here with the long candle wick and the small candle body is called a hammer or a pin bar, that you may have heard it as. The way that you know that this is a hammer or a pin bar, it's the same thing. The way that you know that it's this is you use the crosshair. You can click on the crosshair, which is here, and you measure the size of the body. So measuring the body, you can see the middle number, which says 85. At the minute it says 78. It's because my hand was moving. So the middle number that says 78, this shows you that the size of the candle body is 7.8 pips. In order for this to be considered as a hammer, the candle wick needs to be at least twice the length of the candle body. So in pip terms, that would mean that this candle wick here would need to be at least 14 pips. However, it's 48.4 pips long, so it's clear to see that it's a hammer. So again, a way to define it is a hammer has a candle body a candle wick which is at least twice the size of the candle body. Again, a hammer has a hammer has a candle wick which is at least twice the length of the candle body. That's how you define a hammer. Now this candlestick here is an inverted hammer. I'll just highlight this. So this candlestick here, this is an inverted hammer or inverted pin bar. As you can see, it's the same as a hammer, although the wick is a bit longer. They're both hammers because the candle wick here is at least twice the length of the candle body. So to measure it, the candle body is 146, but in pips that's 14.6 pips, and the length of the wick is 130 pips. So it's clear to say that this is a hammer. When the hammer is upside down, as in the longest point is at the top, this means it's an inverted hammer or inverted pin bar. But when the hammer has the wick at the bottom, the longer wick at the bottom, sorry, this is a normal hammer or a pin bar. So I've just showed you hammers and pin bars. Now I'll show you this is a bearish candlestick pattern. Now the reason it's a bearish candlestick pattern, bearish candlestick patterns you need to take into consideration two candlesticks in order to have a bearish candlestick pattern. So these two here is what we're focusing on. I'll change the color. So we're looking at this green candlestick and this red candlestick here, and I will actually label it for you. Bearish. So you can see this is a bearish engulfing candlestick pattern. The reason why it is called a bearish engulfing is because you can see that the bearish candlestick here, this large red candle, the candle body is engulfing, aka eating, the previous bullish candlestick. So what this actually means is, for it to be a bearish engulfing candle, the red candle or the bearish candle, in my instance, because of the color that I've got the charts, the red candle is engulfing the green candle, or the bearish candle is engulfing the bullish candle, and only worry about the candle body. So as long as the candle body is engulfing the previous candle body, this is a bearish engulfing candlestick formation. I'll show you another example of a bearish engulfing candlestick. That is here. And this is a good example because I know that some of you may think that because the candle wick on the bullish candle is longer than the candle wick on the bearish candle, this is not a bullish engulfing pattern. However, I did define the bullish engulfing as the bearish candlestick body needs to fully engulf the previous candlestick, and in this instance the bearish candlestick body must engulf the bullish candlestick body. So because the bearish candlestick body does engulf the bullish candlestick body, this is a bearish engulfing candle, and I'll label it here. So this is a bearish engulfing candlestick pattern there, using these two. Remember, the bearish candlestick body fully engulfs the bullish candlestick body. So this means it's a bearish engulfing pattern. Now I'll show you a bullish candlestick pattern, bullish engulfing. These two candles here. Again, even though this candle wick is lower than this candle wick, we're looking at the body. So the way you define the bullish engulfing pattern is the bullish body needs to be larger than the bearish body. So you can see that the bullish body fully engulfs the bearish body. So this is a bearish candlestick pattern. Bullish candlestick pattern. Bullish candlestick pattern, aka the bullish engulfing pattern. So the bullish candlestick body fully engulfs the bearish candlestick body, and I'll show you another example, which is here. So you can see looking at these two candles here, and this large bullish candle fully engulfs the body of this red bearish candle. So this is a another example of a bullish engulfing pattern. So now I've covered so far I've covered a hammer, which is here, an inverted hammer, which is a upside down hammer or pin bar, which is here. So there's an inverted hammer, inverted pin bar here, a normal hammer or normal pin bar, which is here. You can see a bearish engulfing pattern, which is here, because the bearish candlestick body is fully engulfing the bullish candlestick body. Don't worry about the candle wicks. There's another bearish engulfing pattern here, because the bearish candlestick body is fully engulfing the bullish candlestick body. So this is a bearish engulfing, and again this is a bullish engulfing pattern, because the large bullish candlestick body is fully engulfing the bearish candlestick body. And the same thing here, this large bullish candlestick body is fully engulfing this bearish candlestick body. So these are bullish engulfing patterns. Now I'm going to show you a spinning top or a doji star. Let's try and find one by eye. And here's an example here. You can use either of these. This is a spinning top. So a spinning top means that the candlestick body, the candle wick needs to be at least twice the length of the candlestick body. So both candle wicks on the upper end and the lower end must be at least twice the size or twice the length of the candlestick body here. And I'll show you. I'll get the crosshair and measure. So the size of the candlestick body here is 6.5, aka 6.5 pips, and the wick at the upper end is 73.4 pips, and the wick at the lower end is 45.3 pips. So this is a spinning top, because the reason it's a spinning top again is because on both candle wicks, meaning the upper candle wick and the lower candle wick, must be a minimum of at least twice the length of the candlestick body. So this is a spinning top. So I'll highlight this now. So this is a spinning top. A spinning top actually represents indecision in the market. So they work great when you have, if you can't actually, I wouldn't recommend making trading decisions from seeing a spinning top. I recommend waiting for the next consecutive candle and seeing the actual trend or market direction, because again, spinning top or doji star represents indecision in the market. And just to add that the spinning top is also known as a doji star. But this one here is another example of a spinning top and a doji star, but it's a bit can also so this candlestick here, you can see that this line here means that the open and close price was basically the same, and you can see that the price was pushed down but it didn't close down there, and price was pushed up but it didn't close down there. And you can clearly see that the upper candle wick and the lower candle wick are at least twice the size of the candlestick body, because the candlestick body is very small. I'll find one more spinning top. Here is a spinning top here, and I'll measure it for you. The candle body here is 13.1 or 131, but in pip size it's 13.1 pips, and as you can see the upper end is 34.2 and the lower end is 33.4. So as you can see, this is a spinning top because the upper candle wick and the lower candle wick are both at least twice the length of the candle body. So I'll just arrow this now too and write it down. So this arrow here is pointing at this candle, and this candlestick is a spinning top, and spinning tops are also known as doji stars. So don't be confused when you hear someone mention a doji star, because a doji star and a spinning top is the same thing. And again, I do recommend not taking trades solely off a spinning top or a doji star, because spinning tops and doji stars represent indecision in the market, and I recommend waiting for the next consecutive candle to determine the direction of the market. So these are the key candlestick patterns that you need to know about. I don't recommend learning about, but you can learn about the other candlesticks. But however, based on my experience and live trading, I've discovered that the most important candlesticks to cover are the spinning top and doji star, which is the same thing, which is this candlestick here, and you can also see it, this candlestick here and this candlestick here. All of these candlesticks are doji stars. Another important candlestick pattern is the bullish engulfing candlestick pattern, which is here. I've already explained this one. You can see another bullish engulfing candlestick pattern here. Right, and here you can see a bearish engulfing candlestick pattern, and then finally you can see another bearish engulfing candlestick pattern or candlestick formation. They're the same thing. And finally you can see the hammer, which is here. This is a hammer or a pin bar, it's the same thing. And there's another hammer or a pin bar, which is the same thing, and they can be seen on any currency pair. I'll show you another hammer. This is a hammer here, and this is a hammer here. So remember that hammers and pin bars are the same thing. This candle. This is a inverted hammer, and this is an inverted hammer and inverted pin bar. So these are the key candlesticks or candlestick formations to follow, being an inverted hammer or inverted pin bar, which is there, or a normal hammer, normal pin bar, which is there. This is a hammer pin bar, this is an inverted hammer or pin bar. This is a bearish engulfing, bullish engulfing, bullish engulfing, and a spinning top or doji star, spinning top and doji star. And again, it's good to go through charts and actually be able to identify them, because it does help a lot with your trading, and it helps you to identify candlestick patterns or candlestick formations when they arise. Again, it's easier when you zoom in. You can zoom out, but it's harder to identify them when you zoom in out, but you can zoom in at any time to help you to identify. So now we've covered the key candlestick formations and candlestick patterns. The next thing that we'll be covering now in the workshop is risk management. So we're on risk management. Well, risk management is a big factor, and it doesn't get enough recognition as it should do, because a lot of people think that to be a profitable trader it just takes a good trading strategy. But one of the main things that I'd like to say is with a good trading strategy but poor risk management, but even with an excellent trading strategy but poor risk management, you will be a losing trader. However, with a mediocre trading strategy and good risk management, you will be a profitable trader. So imagine how you would be with a very good trading strategy and very good risk management. You'll be an exceptional trader. And I believe that based on contacting, well, a lot of people that have contacted me, one of the main things that people do wrong, or they have a problem with, is risk management. Whereas if a lot of people took time to concentrate on risk management, then they would be profitable traders. But in this workshop, we'll briefly touch upon some risk management, because it is it's a topic on itself essentially. But we'll briefly touch it so that you can, after watching this workshop, you will be able to properly use risk management and be able to apply what you've learned. So there's 3 ways to do risk management, or to use proper risk management with trading. We'll cover them in this today, and they get easier as they go on, basically. So, for example, we've already been through how to enter a trade. In this example that I'll show you now, I'll be on a 1 hour chart. I'll zoom in a little so you can see it a bit more. Shift the chart so you can see it, and I'm going to show you how to enter a trade but to use proper risk management, basically. So for instance, on this trade now, what you would do if you would like to take a trade for a buy opportunity, first of all, you put your stop loss at the low of this candlestick here. So your stop loss will be 1.38939. What you need to do is you need to calculate the distance from your stop loss to current price. And you do that by getting the crosshair and drag and drop. So you click, and the distance is 60.3 pips. But what you need to do is you need to first calculate how much risk you like to allocate per trade. The reason you do that is so that you can make sure that you're consistent in your risk management. So for instance, if you want to do 2% risk per trade, what you'd actually do is you'd check your balance, and you do that by clicking terminal and click trade, and the balance is 49983.57. And what you do is you go to the calculator, you type in this same number, 49983.57, and if you'd like to take 2% risk, what you do is you divide this number here by 100. The number is that is 499.8. Round up to the nearest, so we'll call it 84, or you can round down. It's totally up to you, but you must remember this number. This is 1% risk, so you then times, so you can do 499.84 times by 2, so that balance is 999.68. So 2% risk equals 999.68. So now you know that for a trade that you're going to take, for every trade you're going to take, well, for this initial trade you're going to take, with your balance being this amount here, and you wanting to do 2% risk, you know that you can only risk a maximum of this amount here on this actual trade. So what we'll do now, because it's been some time again since we checked the distance, we'll get the crosshair and measure the distance, and it is 56.6 pips. You'll get the calculator and you'll divide this number by 56.6, and that will tell you that each you say that each pip can be to the value of that. So again, let's just calculate it. You have to be quick when you do it this way, but you calculate this number and it's, say, let's just say 54. So 54 pips. Remember the number we previously have, which was 999.68. Divide that by 54 pips. This is 18.51. This means that you are able to take, well, on this specific trade, when you use 56 pip risk, you can have £18.51 per pip. So what you do, you click on the trade, you press new order, you have your stop loss at this number here, which is 1.38939, and you are able to use 18.51 pips per trade, but you have to divide this number by 10, and then you get 1.851. So you change, just look at the first two numbers after the decimal place. So your volume will be 1.85, and then you will enter the trade for a buy position. So now you can see that we've entered the trade. The distance between, well, the distance has probably changed because, as you can see, price is always fluctuating, but previously we calculated it on 54 pip risk. And I'll calculate it again now, but it's actually 61 pip risk now, so you're risking a bit more. That's why I said you have to be quick, but as I'm explaining it to you and I want to make sure you understand it, that's why I'm not as quick as I normally am. But this is the way that I'm explaining it to you now. But even though the numbers have changed, I'll still work it out with the 54 pip risk as we initially marked out, so that it stays within our risk parameter. But again, when doing this way, you must be quick. So this section here that I've marked out in the cream box, the distance from the entry price to the stop loss is actually 54 pips, and I've calculated at 1.85 lot size, which means £18.50 per pip. So that is within our 2% risk reward ratio. Oh, sorry, that is within our 2% risk that you'd like to take. So this means that even if, because you enter the trade and you've calculated your risk management, the worst possible scenario is that you'll be minus 2% down, because you've calculated how much risk per pip you'd like to take based on your stop loss being at this place here. Also, prior to this, you've already calculated how much 2% risk is, which worked out to be the number of £999.68. So that's how you calculate your risk management correctly, using the calculator. Once you've calculated the risk management, it's important to, and you've already entered the trade, it's important to never move your stop loss to a lower level. Reason being is because if you increase your stop loss to a lower level, then you've actually increased your 54 pip risk to something like 64 pip or 84 pips, depending on what it may be. So basically it means that you should never increase your pip risk now once you've already entered the trade, because if you make your stop loss lower than you had initially planned, then it would mean that you're no longer risking 2% and you're actually risking more than your 2%, so you're not staying within your risk management. And it is very important to stay within your risk management if you do intend on becoming a profitable trader or taking it to the next level. But that's how you actually take a trade using correct risk management when using a calculator. Again, it is quite long to do using a calculator, but it's the way that it's got to be done sometimes. So that's the easy, well, this is the most basic form of doing it via a calculator way. I'll show one more. First I'll close this trade. I'll remove those off there. I'll change the currency pair. You can have it at we'll use Euro USD, and for instance in this trade you may want to take a sell opportunity. Again, there's no strategy used at the minute. I'm just simply entering the market and showing you how to use proper risk management using a calculator. So what you do first is check your balance. So this is your current balance. You'll go on your calculator, then you need to enter the same balance, which is, you need to enter in your calculator what your balance is. So that's 49979.59. You then divide this number by 100, and then you multiply this. If you'd like to do we previously done 2% risk. Say for example, if you'd like to do 1.5% risk, you then times this number by 1.5, and then you get the number, which is 749.69. So that means that you can risk that amount on this trade when you're risking 1.5 pips. So for this trade, say for instance we took a sell position, you'd have your stop loss at this level here. You put your stop loss slightly higher than the high, mainly because of the spread. So you put your stop loss there, you click on your chart, click on new order, you put your stop loss to this value here, which is 1.22113. You then must calculate the distance from your stop loss, which is this level, to your entry price. You do that by going to the crosshair and dragging to calculate, and you can see that this is say 919, say 92 pips. So then you go back to your calculator, this is your 1.5%. You divide this number by your 91 pips, and now you can see that each pip must be worth £8.23, or 24 you could say. But then for your lot size, remember you have to divide this number by 10. So divide by 10, and you can see that now your lot size must be 0.82, and then you can sell, and now you would have entered the market using 2% risk. So you've used the correct amount of risk management, 2% risk on this trade. You're within your risk parameters. So sorry, just to go back, I did say that we was doing 1.5% risk, and that's what we've done here because we've already calculated it. That would mean that if price went the opposite way and we did exit the trade, or we left the trade with a loss, then we'd lose a trade with minus 1.5 pips. So having correct risk management basically means that you have a clear cutoff point at which you would exit the trade, and you would exit the trade at a point at which you're comfortable with based on the risk management and risk criteria that you set. In the previous trade I set it at 2%. In this trade now I set it at 1.5%. And again, you calculate or you do tests to make sure that the risk that you're allocating for the trade that you're taking is a level of risk that you're comfortable with, and you are happy that your trading strategy that you're currently using can handle. I'll get into that as well, but that's another example of how to use a calculator to use proper risk management when making trades. I'll just close this trade now. And again, risk management is a very key factor, because with proper risk management and a mediocre trading strategy, you will be a profitable trader. But with a very good trading strategy and poor risk management, you won't be a profitable trader. So again, this is a very key aspect of trading, risk management. But in this workshop, we're only briefly touching upon it so that you can use it properly and understand how to use it. So just to check, we're still on risk management. We've covered the calculator side of things, but now we're going to go to a much faster way, which is the Excel side of things. So what we do, we go on to our trading platform. We'll zoom out a bit. We'll check on the terminal, see our balance. I have an Excel file. You can actually contact me if you'd like to get involved and get the actual Excel file. It's a lot faster than using the calculator way, but I have to show you the calculator way so that you understand the concept and how to and you understand how to actually manually do risk management, because you may be in a position where that's all you could do, or you may not have the Excel file, as some of you may not, or you may not have the other tools that I have to help you do correct risk management. But again, using a calculator is route one, and it's something that is very good to know, and it helps a lot. So now I'll show you how to use risk management using an Excel file. So now I'll show you how to use the Excel file and how it's a lot quicker than using the calculator. So what you first need to do is, well, you need to have the Excel file. If you don't have it, you can contact me and we'll sort that out. You go to your trading platform, click on your terminal, click on trade so you can see your balance, and you can see that the balance here is 49989.59. You go to the Excel file and change these numbers here. So 49 make sure that you change all of the numbers. And you would also make sure that you change these numbers at the start of your trading session, rather than sorting out these numbers once you've found your trading opportunity. So check that they're all the same, and they are. You'll go back to your trading platform. We can change the currency pair. GBP USD. You may want to take a buy opportunity. So again, we do the same thing with the horizontal line. You get the horizontal line, you then place the horizontal line at the point at which you like your stop loss to be. Click on new order, press stop loss, and press this exact number where you'd like your stop line to be into your stop loss. So that's 1.38935. Don't press anything yet. What you'll do, you'll get the crosshair and measure the distance from your stop loss to the entry price. It happens to be 40 pips. Now what we'll do is you go onto the Excel file, and all you do is change the max stop loss number. You keep everything else the same here. You can change your risk percentage. I started off doing 2% risk. On the last trade we did 1.5% risk. On this trade now we could do 0.9% risk. That means we're risking 450, and because it's been a while, we'll quickly check the distance again. You can see that now it's 42 pips risk. So you go on the Excel file, and in the max stop loss press 42, and it will tell you that the entry lot size must be 1.07. You go to the trade and press 1.07 and press buy. So now you've entered the trade with your correct risk management, and you know you didn't have to do the long way, which was the calculator, because the Excel file automatically calculates it for you. All you need to do is change the max stop loss value, keep everything else the same and keep the max stop loss value, keep everything else the same and just change the max stop loss value. What you can also do is you can I'm just showing you how to use it now. You can change the stop loss, the percentage risk to any amount. You could have 5% risk if you like. When you have 5% risk, you can see that your overall monetary risk increases substantially to nearly 2,500. You could do 2.5% risk. You can basically do any amount of risk you like to take, even 0.2% risk. It's totally up to you what level of risk percentage you could take. But once you've changed the percentage risk, leave it the same. It's best to stay consistent when it comes to percentage risk, whether it be 2%, 3%, 5% or 1.4%, any amount of percentage. You need to stay consistent with your percentage risk. Speaking about percentage risk, you need the way you determine how much risk to take is not based on. It needs to be based on you testing your strategy yourself, because a lot of people think that you can just listen and hear that you should stick to 2% risk or stick to 3% risk. What you actually need to do is you need to have your own trading strategy. Then you actually need to test the strategy so you can see how profitable the strategy actually is. Once you've then got that data, you can then see how much percentage risk you can take and allocate to each trade. Because if, for instance, if you have a trading strategy that presents to you 20 trading signals a day and you're taking 2% risk, that would mean that you're taking 2 times 20%, 20 times 2% risk, which equals to 40% risk throughout the day. That wouldn't be very clever, and wouldn't be very good risk management, because you could potentially wipe out 40% of your capital in one day. So the smart thing to do, if you had 20 trades to take and you actually had to take them because it's based on your trading strategy, and you wanted to take, for example, 20% risk or 10% risk for the day, what you'd actually do is you take 0.5% risk per trade, because you're going to take 20 trades. So now I've just shown you an example how you can. Well, I've shown you can change the number. We'll leave it at 2%. So this goes back to 1,000. And once you've got this Excel file, you don't have to make any other changes. The only change you'll make is the percentage risk, and that's based upon your trading strategy and how many trades you actually have and how much risk you'd like to take, because some people are risk averse and some people like to take risk. But if you want to be conservative, you need to actually calculate how profitable your trading strategy is. But once you've already done all of that, you won't need to change any of this percentage risk value. Or the only number you'll have to change is the max stop loss, and that is based on the amount of pips that you have at risk. And all you do to calculate that is calculate the distance from your stop loss to your entry price. So for instance, we'll close this trade now. But I won't make any more trade. I'll just show you an example. If you was to take a trade on Euro CHF for a sell position, and you'd have your stop loss here, you calculate the distance from your stop loss to your entry price, which is 28.3 pips, just call it 24 pips. Go to your Excel file, press 24, and it will tell you that you can have your lot size at 4.16 lots per trade, or for that specific trade. And when you actually do proper risk management and deal with risk management correctly, when you use either a calculator or a Excel file, you will notice that each trade that you actually take, all the lot sizes will be different, because no trade is the same. And what I mean by no trade is the same is that not every single trade you will take 20 pip risk. Some trades you'll take 17% risk, or 17 pip risk, sorry. Some trades you'll take 34 pip or 174 pips risk. What that means is all you need to do is go to your Excel page, calculate the amount of risk you like to take, and it will automatically calculate you calculate the lot size. So for instance, if you take a trade and you need 175 pip risk, it's telling you to have your lot size at 0.57, and that is found when you press the order and you change this number to 0.57. But I'm not going to make the trade, I'm just showing you an example of how that actually works. But so I've shown you two ways. I've shown you the calculator way of risk management, and I've also shown you the Excel file way of risk management. If you'd like to get the Excel file, just contact me and I'll get that sorted for you. But the other way, this is the way that I use myself, is it's a bit of software. So the software actually enables me to make trades without me having to go to the Excel file and type in numbers. All I have to do is, I'll actually show you now. Say for instance, I'll trade GBPJPY. I'd like to take a sell position. All I do is click on this, press sell. This red line comes automatically. I can move the red line because this represents where I'd like my stop loss to be. The risk here, which says 2.0, this is always done as a percentage based on this bit of software. You can change it to any number you like. It could be 4% risk, or it could be 1.5% risk. And all I have to do is actually, I can move the stop loss again like I mentioned anyway. I don't have to calculate the distance. I don't have to go on Excel file. I don't have to use a calculator. All I need to do is decide where I'd like my stop loss to be. I'll have it there, press submit, and the trade has been taken. It's used the correct risk management, and see, you can see the lot size is there. It's used 1.5% risk, and the trade has been taken. To close the trade, do it as normal. Another example of this is having another trade, pressing sell. This time I'd like my stop loss to be here, and I'd like to use 2% risk. Press submit. The trade's already been taken. You can check the terminal, it's already there. I can close the trade. I'll show you one more time using the quick way. This is the way that I use myself. So I'll just press, this time I'm going to buy. So I'd like my stop loss to be here, and I'd like to use, this time I'll use 1.7% risk, and this is just to basically show you that you can use any percentage risk that you like to use. It's totally dependent on you and your strategy, but it's just to show that this bit of software can calculate everything for you. You no longer have to go on the Excel file or have to use the calculator. So this way is a lot better. And all you do is press submit, and as you can see, check the terminal, the trade's been made. It's got a different lot size, so you can see that it's actually using the correct amount of risk per trade. The reason, or also to add, whenever you enter a trade, you start off automatically in the minus because the brokerage charges you a spread for the trade. The spread is what the brokerage makes. So that's why you automatically start off in a minus. That's the cost that it takes per trade. And as soon as you've got past, the price was to go past your entry price, if this trade actually does do that, then you'll no longer be in the red. But again, I didn't take this trade to make a profit or anything. I just took the trades to simply show you how I use this bit of software in order to use proper risk management. But now I'll close the trade. So now I've covered risk management very briefly. Again, it can get a lot deeper on the topic, as it should have its own section, but in this workshop I don't want to dwell too much on it as we're covering other things. But I'd just like to say, when you are doing risk management, you do need to understand that you must firstly have a trading strategy, and then once you've tested your strategy, you can then see how profitable your strategy is and how many profits it has, how many losing trades it has, how many losing trades in a row it has, for you then to decide how much percentage risk you'll take and what sort of risk management tactics or strategy you'll use. But again, in this workshop we can't cover all of that, but I know that now I've briefly covered it. If you like any more information on it, then don't hesitate to contact me, or if you like the Excel file or the bit of software, then contact me and we can sort that out too. So now we've covered risk management. The next thing to cover now is the RSI. Well, the next thing that we'll be covering now in the workshop is the RSI, the relative strength index. We'll be covering divergence. So first of all, we'll go to the chart. Based on experience, I've found that the RSI works well on the 4-hour chart. So what you do, the way you get this is to click on the chart, insert, indicators, oscillators, relative strength index. This is how it will look when you apply it to your chart, like this thing at the bottom. I'm just going to make a couple of changes. So you right click, RSI properties, add the 50 level, make this black, press OK, and now as you can see, I've added the RSI. You can see it a lot better. We've got the period set to 9. You can, sometimes people may have it set to 14 period, but based on experience I've found that setting it to 9 works best. The RSI, or the relative strength index, is a momentum oscillator. There's various other momentum oscillators, but I've figured that, and based on my experience, I figured that using the RSI to help you identify divergence works best, as is the best oscillator for this task of identifying divergence. So now I'll show you some divergence. What divergence actually is. Well, first of all, I'll show you some bearish divergence, and because it's bearish, I'll make this pink as so this is one high here, and this is another high here, 2 highs. So that's one high, that's just the other high, and you can, this is the only time I recommend drawing the, well, first of all we'll identify, you get the vertical line. I'll make this vertical line blue, also make it a bit thinner, and the other vertical line. The reason you put in vertical lines is so that you can see the high points on the RSI and they match up with the high points on price. So if you look at price, this vertical line is here, it goes in line with this peak, and this high here goes in line with this peak on the RSI. So I've highlighted these two here. I'll also highlight the peaks on the RSI. So what bearish divergence actually is when the RSI, remember this down here is the RSI slopes downwards, so it slopes downwards, however price slopes upwards. So remember, you're not drawing, just to remember, sorry, you're not drawing a trend line here for a downtrend or anything. You're simply using the trend line as a way to easily identify RSI divergence. In this instance, we're I'm showing you RSI bearish divergence. So when price, this is the previous high, price went down, but price made a new high here, which is here. However, when price made a new high, the RSI made a lower high. So what that actually means is, and what this RSI is actually showing, when price was pushed up by the buyers to this level here, You can see the RSI was at a good level. It was showing strength in the market. However, when price retraced and price went higher than the previous high, which is here, the RSI made a lower high to the previous high on the RSI. That means that even though price made a higher high, there was not the amount of buyers. There was not as many buyers as there was previously. So that means that the strength in the market has decreased. So bearish divergence is when price makes a higher high to the previous high, but the RSI makes a lower high to the previous high. This is early signs of a change in market sentiment and showing you signs that the strength of the sellers or strength of the buyers has decreased and the market is likely to change. So this is showing RSI bearish divergence. Also, to add, you can also see what we covered earlier. You can see a hammer, an inverted hammer or an inverted pin bar at this same point here, and also a bearish engulfing pattern, because the bearish candle body is fully engulfing the bullish candle body. So you can see a hammer or inverted hammer, inverted pin bar, and you can see RSI bearish divergence. So this is an example of bearish divergence. I'll show you another example now. Well, actually I will now show you an example of bullish divergence, which can be seen here. I'll highlight this low here in pale green because we're showing bullish divergence, and this low here. So as you can see, this low here is lower than this low here. We get the So I've just used the horizontal line so I can show that I'm going to highlight the exact same points on the RSI. Can now remove these points or these vertical lines, but you can see that when price made a lower low here, the RSI actually made a higher low. So what we'll do now, we'll get the trend line again. I'm not using the trend line to show trend. I'm drawing the trend line on this to show RSI divergence, and this is actually RSI bullish divergence. So when price makes a lower low, the RSI actually makes a higher low. So again, price made a lower low. This low here is lower than this low, but the RSI at this point is higher than this low. So this is bullish divergence. So price made a lower low, but RSI made a higher low. This is showing that the sellers are weakening and the buyer, and it's showing that the RSI is showing that the sellers are weakening, and it's showing early signs that the market is likely to change sentiment and that the buyers are likely to take over, and that is represented here, where you can see that the market then has gone into an uptrend. So I'll find another example. Here's another example here. That's one low. Here's another low. Get the vertical line. So now we can delete these vertical lines here. And you can see that this low here is lower than this low. So price made a new low. However, the RSI made a higher low. So again, we get the trend line. And you can draw. Again, we're not drawing the trend line to show trend. We're drawing the trend line to show RSI divergence, and in this case it is bullish divergence. Draw the same trend line on the RSI. So when you're looking for bullish divergence, this means that the trend line slope on the price will be sloping downwards, but the trend line on the RSI will be sloping upwards. So this is showing bullish divergence. And what that shows is, the way that you use this is, if price went to this level here and started retracing and going up, but then you can start seeing that the price is then going down, you'd wait for price to go below this level, which is the previous low. You'd like price to go below the previous low. However, you'd like the RSI to be above the previous low on the RSI. That followed by this bearish engulfing candlestick pattern here that we spoke about earlier. So you've got bullish divergence followed by a bullish candlestick pattern. These are very strong signals, and if you followed this trade here, you would have gained possibly 275 pips. If we use the same thing here, you could have gained over 100 pips, or if you held on a bit longer, over 300 pips. If you used this bearish divergence signal here and you got into the trade on the pin bar, you could have gained over 275 pips. Or if you got into the trade on the engulfing pattern, because the bearish candlestick body here fully engulfs the bullish candlestick body, and you would have entered on the close here, you could have still over 230 pips. But this is divergence, and it can be used on any currency pair. I'll show you an example again now. We'll use GBP USD chart window. So you go insert, indicators, oscillators, relative strength index, everything should be the same. Press OK. We're on a 4-hour chart, and now look for signs of divergence. And you can see some bearish divergence here. I'll change this color to a pink so that you know it's bearish divergence. So that's one high there. This is another high here. We'll get the vertical line. And I'll highlight down here too. And I'll delete the vertical line so we can see better. And you can see that price, for example, if you couldn't see what was going on, you could see that price made a high, the RSI made a high, and then price went down and then made a new high, which is here. However, even though price made a new high, the RSI made a lower high. So this is bearish divergence. Again, when you have bearish divergence, we're using the trend line to draw a slope. We're not using the trend line to show trend, we're only using it to show bearish divergence. And when you do that, you can see that on price, when you use bearish divergence, on price the trend line needs to be sloping upwards. But however, when we use the trend line on bearish divergence on the RSI, the trend line will be sloping downwards. So this shows bearish divergence. Again, I did mention that RSI divergence can be shown on any time frame and any currency pair. I previously showed it to you on Euro USD, which is here. So you can see. So again, this is bearish divergence. Price makes a higher high than the previous high, but the RSI makes a lower high than the previous high. This is a very strong indication that price is likely to change direction and to trend direction will change. So you're now in a downtrend. We also had a bearish inverted hammer or a bearish engulfing pattern. In this example here, you have price making a lower low to the previous low, but the RSI making a higher low to the previous low, showing RSI bullish divergence. However, there's no clear there isn't a one of the key candlestick patterns that I showed you earlier present in this example. However, it's still showing a clear sign of bullish candlestick, bullish divergence. And then finally, on this one here, price makes a lower low to the previous low here, but the RSI makes a higher low. So the price slopes downwards and the price slopes upwards, followed by a bullish candlestick pattern because you have a spinning top, and a bullish engulfing pattern because the bullish candlestick body fully engulfs the bearish candlestick body, which is showing you a bullish engulfing candlestick pattern. And if you held on to the trade, you could have gained all that profit. So that now we just covered the RSI, which is an oscillator, and oscillators are good for showing strength in the market and likely changing trend direction. But again, from my experience, I found that the best oscillator to help you to identify divergence happens to be the RSI. There's other oscillators that we can use. I'll go through them as well, but this was the RSI. So the next thing to cover now will be the MACD, moving average, convergence and divergence. Yeah, so I just mentioned that we're going to be covering the MACD, which is moving average, convergence, divergence. We'll head over to the trading platform on Euro USD. Make this a 4-hour chart. And the way you get the MACD is you press insert, click on the chart, insert, indicators, custom, MACD. Leave everything the same, press OK. And here you can see at the bottom here is the MACD. You can change it by pressing right click, MACD properties, and you can change the colors. I like to have the red line a bit thicker and the color being here black, so you can see it a lot better now. The MACD is a trend following momentum indicator. It's a lagging indicator as that's what the move is, as it's worked on moving averages. I did mention before in the workshop that moving averages are lagging indicators. This is a lagging indicator, but it works well so that it tells you, for example, what you could do is when the red line is above the 0 line in the MACD, you may only take buy opportunities. So for example, in this section here, I'll just get the horizontal line. You can see this line here that you can see on the MACD is the 0 line. So you can say that if the MACD, the red line, is above the 0 line, then you will only take buy opportunities. It's quite similar to how you can use the moving averages that I mentioned to you earlier in the workshop, but it's just to show you it as an indicator. So for instance, you'd only take buy opportunities within this level here. The reason being because the red line, which is the signal line on the MACD, is above the 0 line. Also for this section here, you can see it's a lot more prominent. The red line crossed above the 0 line here at this point, and you can see that the MACD stayed above the 0 line all the way until this section here. So you can see that, I'll just highlight it now, make it a different color. So the section that I've highlighted now shows in the MACD, on the MACD, sorry, the section on the MACD that the red line, the red signal line is above the 0 line. So again, I did mention, based on experience, I've worked out the best way to use the MACD is when the MACD is above the 0 line, to only take into consideration buy opportunities. So by doing so, and by only taking buy opportunities, you then don't allow yourself to take any false trading signals within this period that are showing sell signals. For instance, if you took some sell signals within this area here, you may have lost some money. The same with here, and the same with here, depending on the time that you got out, obviously. But again, you do, when trading, ideally you will be trading with the trend, as it's a lot safer to do so. And by using the MACD and making sure that you only trade in the direction that the red signal line is above the 0 line, it enables you to only take buy opportunities. Now I'll go back and I'll show you, for instance, in this period here, get the vertical line again, sorry. You can see that from this section, from there to there, from here to here, I'll also highlight it. If you was to follow the MACD rule, you would say that if the red signal line is below the zero line here, you will only take sell opportunities, meaning you will ignore or buy opportunities. It can save yourself a lot of money. You can see that by in here, there's a few bullish candlestick patterns here, like there's a bullish engulfing candlestick pattern, there's a hammer here, there's another hammer here, and there's a bullish engulfing. But by you following, if it was your rule that you wouldn't take any buy opportunities if the red line is below the 0 line, you've then saved yourself a lot of money by not taking those trading signals. So for example, again, it's a very easy way to use the MACD, but it's very helpful, and it's quite similar to the way that I showed you how to use the 2 moving averages closer to the start of the workshop. And the way you do it, again, I'll quickly explain, is if the red line is below the 0 line, then you will only take sell opportunities, and if the red line is above the 0 line, you will only take buy opportunities. Again, it's a very basic way to use the MACD, but based on experience, I found it's the most effective way, and this, alongside other parts to your trading strategy, is a good way to make sure that you're trading within the trend, within the market trend. As I mentioned before in the workshop, the trend is your friend, and you do want to be trading with the trend. But remember that trends do change, and not to be so stuck up on trading with the trend. But again, if you can find the trading signal that is within your rules for the MACD, if you wanted to use the MACD, then this would help you to eradicate a lot of false signals that you're actually getting. So to conclude, I'll say the MACD is a good and simple tool to use in a way to help you to reduce the amount of losing trades that you may be having. But that's the MACD. So the next thing that we'll be covering is Fibonacci. So we'll head over to the platform, right click, template, blank charts, it's back to normal now, and Fibonacci. So a lot of you may have heard of Fibonacci, but now I'll show you how to correctly use Fibonacci. So first of all, what you will do, if your Fibonacci is not here, you go by the cursor, right click, go to customize, or remove, and what you're looking for on available is Fibonacci retracement. There's Fibonacci time zones and fan and arcs and expansion, but we're focusing on Fibonacci retracement. So you click on that, press insert, you can see that it popped up there, and then press close. So what you do when drawing Fibonacci, you can see we're in the uptrend here, For example, we're in an uptrend here. What you would have did, you would have clicked on the Fibonacci, and when you draw in the Fibonacci for an uptrend, you always draw it from low to high. It has to be from low to high. So you click at the bottom and draw it there. Double click, right click, Fibonacci properties, and you can press defaults, so everything's back to normal. Press OK, and as you can see, that's how it will look. But one of the things that I've, based on my experience in trading and using Fibonacci, I discovered that it's good to add another level. So what you actually do is you double click on Fibonacci, right click, Fibo properties, press add, and type 66.0, press OK, right click again, go down to 66.0. So what you actually do, is you right click on Fibo properties, you just delete it, so it looks the same for you when you do it. You right click, Fibo properties, add, press 0.66, and on description 66, press OK. You can see that another line here has been added that says 66, and what that is based on Fibonacci. If you've done any research yourself, they'll tell you that Fibonacci retracement works best between 38.2 level and the 61.8 level. Based on my experience, I discovered that it works best to the 66.0 level. And what you actually do, I did mention before, is when you draw in Fibonacci for an uptrend, you must draw the Fibonacci from low to high. Make sure that it's touching it, and then what you would do as part of your strategy, if you was to use Fibonacci, you'd highlight the area. I'll change this color to a pale green. What you would say is you draw the Fibonacci from the low to high, and it would be part of your system to say, once price reaches the 38.2 level, well, my price level between the 38.2 and the 66.0, I will look for bullish candlestick patterns or bullish candlestick formations within this area, and then I will look for opportunities to buy and enter the market. As you can see, within this area here, there's a bullish engulfing candlestick here, then there's a morning star candlestick pattern here, which this one failed here and this one failed. However, this candlestick pattern here, which is a spinning top or doji star and an engulfing, so you can say a bullish engulfing candlestick, this candlestick pattern here, if you followed this system, you could have gained over 217 pips. So that's how you correctly draw the Fibonacci on that section there. You can also draw Fibonacci longer, so you can click on Fibonacci, you can draw it from the low there to the high here, but then as you can see, the price didn't touch your 38.2 level, so that's not very good. Or you can just simply draw it from the low here to the high here, then get your rectangle and highlight your key level, remember between 38.2 and 66.0. So you then say that you've applied your Fibonacci, and you'll wait for bullish candlestick patterns within your marked out level, which is between the 38.2 level and the 66.0 level. You'll look for bullish candlestick patterns and look for opportunities to enter the market for a buy position. If you entered on this candlestick formation here, which is a morning star, you could have potentially gained over 360 pips, and that's based on using the Fibonacci. So I've shown you two examples of using the Fibonacci retracement for when you are in an uptrend for buying opportunities. Now I'll look for Fibonacci in the sell opportunities. When you draw in Fibonacci for sell opportunities, you must draw it from high to low. So for bullish, it's from low to high, but for bearish, it's from high to low. You can see that I drew the Fibonacci here. However, the price did actually pierce through the 66.0 level, so you wouldn't actually follow this. Let's look for another opportunity. This is more current time as well. So you click on the Fibonacci, you draw it from this high here to this low here, and again you can see that price did actually pierce through 66.0 level. However, at this point price did not close above the level, and you do actually have a inverted hammer. And if we do insert the indicator, the RSI, you can see that price found resistance at the 66.0 level. As you can see, price did not close above it. It has a long inverted hammer. And also, I'll just highlight it now, that I highlighted very similar to what I highlighted before. You can see that there is bearish RSI divergence present. So that just shows that you can use other technical tools together to help you make better trading decisions. So for instance, you already know that you're in a downtrend. You can see that you've drawn your Fibonacci. You can see that there's a level of resistance. You can see that price has exceeded past the 66.0 level, but price did not close above the level. And you can also see that there is RSI bearish divergence followed by an inverted hammer, and further confirmation is a bearish engulfing pattern. So there's a couple of things that are telling you to take a sell opportunity on this trade, and as you can see now, the trade is still going. If you was to enter the market, you could have gained over 270 pips. So I've shown you a couple of examples of how to use the Fibonacci retracement tool. I'll now show you how to look for one more opportunity for bearish. So what I did here, you get the Fibonacci tool, you draw the Fibonacci when you're drawing resistance from high to low. So that's drawn there. You get your rectangle, highlight this level, which is between the 38.2 and the 66.0, and you'd say that you look for bearish candlesticks formations or candlestick patterns within your area and look for opportunities to sell. And you can see how effective the Fibonacci actually is. The only problem that I've discovered with Fibonacci is that sometimes it takes a long time for the trades to actually take place, and you could be waiting a long time for price to actually enter your areas, and sometimes price doesn't enter your area at all, or may exceed your area. So be careful when using the Fibonacci, as you may not have as many trading opportunities as you may wish. But again, it's a very good tool, and when used correctly, you won't have any problems with it. But now I'll try and find one more example so that I can show you that you can use the Fibonacci for current price. For example, you can see that we're in a clear uptrend here, but at the minute you can see that price fell and tried to go up again, but price is falling. So you like to know where price is likely to find level of support. level of support meaning a level at which buyers would then push the price up so that price can then exceed its previous high. What you do is you click on Fibonacci, draw the Fibonacci from the low to the high, which is here. As you can see, when price retraced, it nearly touched the 38.2 level, but it didn't. That's probably why it didn't exceed the previous high. Use chart shift so now you can see a bit further on the chart, but we'll go to the rectangle so that you can draw your Fibonacci key level, which is between the 38.2 level and the 66.0 level. And because it's it's bullish Fibonacci we're drawing, and we're looking for bullish key levels, we'll do this rectangle in pale green, and this is how you'd use the Fibonacci. You draw your Fibonacci lines, you'd see your key area, which is in between the 38.2 level and the 66.0 level. You can see that price nearly reached it at this level here, but it didn't, and then price was pushed up by some support and buyers pushed it up. However, there were not enough buyers at this price to be able to push price so that it surpasses its previous high. Instead, it's possibly likely that price will enter this area between the 38.2 and the 66.0, and within this area, if you was to use Fibonacci as part of your plan, I'd advise to look for some bullish candlestick patterns within this area and opportunities to buy so you can enter the market and hope for a big move up. But that is how to use Fibonacci. Now we will cover the volume indicator. It won't take very long. Go over to the chart. The way you get the volume indicator is you insert indicators, volumes, and this OBV, which is unbalanced volume. But all these indicators are the same. You can change the color if you like. So as you can see, it's volume. What volume indicator is supposed to show you, or supposed to indicate to you, is where the buyers are and where the sellers are. However, I don't advise using any volume indicators on Metatrader 4 or on any platform itself. The reason being is the volume indicators will only show you the volume that specific brokerage is handling. So it won't show you the volume on the market overall. It will only show you the volume on that specific trading platform. And if that's a platform or a brokerage that, well, there's so many platforms and there's so many brokerages out there that there's no way to get proper data from the volume unless you're going to be getting the volume from a place where it calculates all volume. Then I'd say that it's completely pointless, because again, it's only calculating volume on your brokerage rather than volume across all brokerages. So again, I wouldn't advise using any volume indicators, and I don't use them myself. So that's very quick, but it's just a quick way to teach you and to show you that you should not be using volume indicators, and I don't recommend them. So I'll delete that. Now, one of the main things now that I know a lot of you have been waiting for, and that's strategy development. So a lot of people ask, how do you create a strategy and how to get started? So now I'll show you how to do it, basically how to develop your trading strategy and get it going. Now, the strategy session, we'll be calling this moving average trend following strategy. So I'll be incorporating a bit of what I showed you earlier in the workshop and showing you how to develop a strategy. First off though, I'd like to show you what a strategy must include. So what does my strategy need to do? Every strategy needs to do this, otherwise it's not a strategy. Your strategy needs to be so blunt that there is no room for any thinking. You just do it because your strategy instructed you to do so. You must trade systematically like a robot. What that means is everything is set in stone, so there's no oohing or ahhing thinking, should I do this or should I do that? The only thought process takes place while you're developing your strategy. Once it's developed and ready, all you need to do, if it's made properly, all you need to do is follow your strategy, a bit like following a recipe. So you just follow a step-by-step guide, and it tells you how to enter the trade, how to exit the trade, when to take profit, when not to take profit, or when to lock in a profit, and even also when not to take a trade. For instance, if your strategy has 10 points that need to be met, 10 points of criteria that need to be met, and only 9 points are met, then you wouldn't enter the trade. You have to be so strict with your trading strategy. So your strategy needs to let you know when to take profit. That by doing so, it enables you to stop being one of those traders that enter trades, you end up being in profit, but you don't take profit because you keep thinking that the market will give you more profit, when in actual reality you should have locked in your profit, or possibly even cashed out all your profit, so that you would have left with something. That's good risk management. So your strategy needs to let you know when to cut your losses. This is done by a stop loss, so it has a cut-off point, a point at which you know that your trade is wrong and you're better off out of the market. Your strategy needs to know when to leave your profits to run. So don't be a trader that just cashes out profit too early. Instead, you want to make sure that you let your profits run and get the maximum amount of profit, because that's good risk management. And your strategy also needs to let you know when not to enter the market and preserve capital. That's like, for example, you don't want to be just a trader and just essentially entering trades. You want to be a trader and making sure that you only enter highly profitable trades based on your trading strategy. So essentially, it's a bit like going to war, and you can either be two types of soldiers: go into war and wave your gun around and shoot blindly, blind fire, aiming at nothing, or you can be a sniper that sits and waits patiently for your trade, make sure everything lines up, all your criteria, then pulls the trigger, so you're more likely to hit your target. So all your strategy must include all of this. This is a key factor, key thing. So now we'll go over to the platform, and I'll drag and drop Euro USD. Blank chart. So it's going to be a technical strategy using technical analysis and some of the indicators that I showed you earlier. So as it's called a moving average trend following strategy, we're going to be using or applying moving averages. So the 40 simple moving average, and the 10 exponential moving average. We'll have this in blue. You can also, when you make a strategy, you can have it for any sort of time frame, but it's totally dependent on yourself. And the reason why we're doing the 10 and the 40 is because we're going to, when I showed you the moving average strategy earlier in the workshop, the moving average combination earlier in the workshop, and I told you it helps you to determine trend. We're using these two moving average now to help determine trend. Or we can have this one at a 20 moving average, so it's a bit faster, and then change this to a 4-hour chart. As you can see, it's a lot faster. Or we could move it. You can have any kind of numbers you'd like to have for your moving average. So at the minute we've got 10 and 60. We're going to be using this 4-hour chart. We're going to be using this 4-hour chart to help you determine, or help us determine which trend the market is trading in. Because what I said earlier is it's good to use these moving averages to help you determine market trend. Once you've determined market trend, you should trade with the market trend. because trading with the trend is the best thing to do. It's a lot safer. So now we'll be using this chart here to help you determine market trend. So I add another currency pair, the same currency pair, which is Euro USD. We'll be trading this on a 5-minute chart. So the first thing we write is determine that's the first thing that you do on a first thing we did, determine the market trend on the 4-hour chart using the 10 EMA and the 60 SMA. So this is basically what I said before. If the 4-hour trend is in an uptrend, we will only take buy signals, but if the 4-hour trend is in a downtrend, we will only take sell signals. So what I'm doing now is I'm making sure that everything is written down and there's no room for thought. Everything's set in stone. So we'll be using this side just to help us determine what trend we're in. So we don't need this chart too big, because you can easily see if the faster moving average is below the slower moving average, then we're in a downtrend, and if the faster moving average is above the slower moving average, then we're in an uptrend. So now this one, this is solely for trend. What we'll do now to make it easier, well, to make you remember that, we'll change the background to yellow. So this means that we're not going to take any trades on this side. It just means that it's solely here to help us determine which trend direction we're trading in. Now on this side, we'll add the moving averages, because we're having a moving average trend following strategy. We'll have the 40 SMA and the 10 EMA. And what you will do essentially is, if you're in a downtrend on this chart, you will only take sell signals. A sell signal is defined as if the 10 moving average crosses below the 40 moving average. So for example, at this point where the moving average crosses, you would enter at this point here on the close of the candle, and you have your stop loss at the high, and then you could have potentially gained 74 pips. So now let's go back to the Word document. So I've mentioned what we've done, but we'll make this larger now. So the thing is, that I've also got to show you is when you actually make a strategy and decide what you're going to do, you also need to make sure that you can reduce the amount of losing trades that you actually have. The way you do that is by adding extra technical tools to help you reduce the amount of losing trades that you actually have. So what we'll do to do that is we'll go back in time and find an example where your trading strategy didn't work. So for instance, you may have had a buy opportunity here when the 10 moving average crosses above the 40 moving average. So first of all, we'll go on to the Word document now and say So now just mention what we'll do. For a buy signal, the 10 moving average in blue needs to cross above the 40 moving average, which is red, to take a buy opportunity. To take a sell opportunity, when the 10 moving average, which is blue, crosses below the 40 moving average in red, we will take a sell opportunity. So that means here, if the blue crosses above the red, you'll take a buy opportunity, and if the blue crosses below the red, you'll take a sell opportunity. But as you know, that sounds very basic, and it actually is very basic, but I'm just showing you a simple moving average trend following strategy, but I'm also going to add a few more technical tools to help you out. So what we'll do as well, we'll find times where you wouldn't have possibly made a good amount of profits. So what you would actually do is, for instance, this section here, when the blue crosses above the red, you wouldn't have made any profits at all. So you go across, highlight this point with a vertical line. Then we'll add another tool. Now we're going to use another oscillator. It's not going to be the RSI, we're going to use the momentum. And you set the period at period 4. There's no levels on there, and I have mine in blue. Press OK. As you can see, that's set. And what we will do is we'll get a vertical line, and you'll put the vertical line at the point at which you'll put the horizontal line, sorry, at the point at which the vertical line meets, so at the cross point, and you see that's 100.0057. So what you'll say is, if you find a buy signal where the blue crosses above the red, however the momentum oscillator on a period 4 is not above 100.109, you won't enter the market. So already we've added a technical filter that's not going to allow you to enter trades that are going to make you lose or be likely to lose. We'll check this one here. At this point, you would have entered the market here because the momentum oscillator is above the line that you've already presented. However, if we check on our 4-hour chart, at this time, which is 25th of April. So the great thing is, at the 25th of April, around this time here, going back to the 5-minute chart, sorry, you are already in a downtrend anyway. And if you go and check our document, we will say if the 4-hour trend is in an uptrend, we will only take buy signals, but if the 4-hour trend is in a downtrend, we will only take sell signals. So now, because this 4-hour chart, which is here, is only in a downtrend, we will only take downtrend signals anyway. So already you wouldn't have taken this trade and you wouldn't have taken this trade, but I'm showing you an example of why you add a momentum oscillator and use it as a filter to reduce the amount of losing trades. But as we've already got the moving average set up on the 4-hour chart to help determine trend, we are only going to trade with the trend anyway, which means that we're going to save ourselves a lot of losing trades. So now you can see from the so you take sell signals from the 20th of April until the 27th. Scroll back. So now you would have cashed out on all these profits here, because the blue line crosses below the red line, and you are in a downtrend on the 4-hour chart, so you could have got 43 pips there. The same thing happens here. You would have got 50 pips there. Now the same thing happens here, but wouldn't have necessarily made a great deal of profit. So what we'll do is we'll see this level here. Use the vertical line. You can see at the point at which the blue line crosses below the red, and you can see at the point at which the vertical line, sorry, crosses the momentum. So we'll get a horizontal line here and mark out this section. So this lets you know that if the momentum is at 99.9644, then you may, if it's not below this level, let's say about there, then it's not not going to possibly be a profitable trade. So you may not want to take this option. But because we're following the 4-hour trend direction, we're not having too many losing trades, because even here you still would have made a slight profit from there to there, which is 10 pips, but we'd like to aim for the larger ones. So that's what we'll do. Now looking at this section here, you can see that the blue does cross below the red, so you could have gained quite a lot of profit. But what we're going at now is the part that I want to highlight, actually, is if you add too many criteria, then you may actually reduce the amount of trades that you actually enter yourself, meaning you may not even be able to capitalize on profitable trades. So for example, if it was part of the strategy that you won't enter the market if the momentum is not at this 99.9638 level, then you won't enter the trade for a sell position. You would have missed out on this trade here, which is just over 45 pips. So that's not something that you would want to do. But at the minute we are checking between the trading between the trend on the 4-hour chart and trading on the 5-minute chart, just using the momentum oscillator as a filter rather than using the 4-hour trend as a filter, and we can identify that this way is working best. So because of that, we can remove the oscillator, because when it comes to developing your strategy, as I mentioned before, all the thinking and all the thought process happens before you actually start trading and making your strategy. Once your strategy is made and set in stone and you actually start trading it, there's no more thinking involved. So you just want to take trades simply because your strategy tells you to do so. What the best thing to do is, also just to add, we're going to add the Parabolic SAR. So click on the chart, insert indicators, Parabolic SAR, press OK. I showed you how to use this earlier. So for example, if you would have a sell signal here, because the blue moving average crosses below the red moving average, you'd enter at the close of the candle, which is here. So you'd enter at this red line at this point. It's highlighted there for a sell signal, and you'd put your stop loss based on the first parabolic SAR that I spoke about earlier. So your stop loss would be here. So you'd enter the trade, how I showed you how to enter the trade earlier, using your stop loss at this point. You'd enter at this point, and you would take the sell opportunity and potentially gain over 45 pips. If you trailed the stop or trailed the trade on your profits with the parabolic SAR, as a new dot's formed, you would lock in profits. And as you can see, once you follow the dot down to here and locked in profits to there, which is 35 pips, if you didn't cash out down here at the bottom, then you would have left the market at this point, because as you can see, price reaches this level and goes above it, and when your stop loss is reached by price, that's when you're kicked out of the trade. So in this trade, you would have left with the 35 pips. So going to the strategy now. Again, this is a very simple strategy, but I'm just showing you how we can use technical tools to develop a strategy that doesn't involve any thinking. So So now I've just written what we've just did. It says we will add the parabolic SAR to the 5-minute chart, and I will use it to help me to place my initial stop loss, which will help me with risk management that we showed you earlier in the workshop. So I will then trail my profits with the parabolic SAR. We will move my stop loss to each new dot on the parabolic SAR to make sure I lock in profits. So that means, again, we put the initial stop loss up here at the first parabolic SAR, and as a new dot's made, you will move your stop loss down so that you're locking in profits, and then eventually you would have locked in up to here, and you would have cashed out from there to there. So to show you another example of where that worked, if you enter the trade here when the blue moving average crossed below the 40 moving average, or the red, you could have got from here down to here, which is 25 pips, and you would have trailed profits with the parabolic SAR. If you entered at this point, you would have placed your initial stop loss at the first parabolic SAR dot, which is there. And again, the same thing happens here when the blue line crosses below the reason why I'm looking at sell signals is because we're in a downtrend, remember, on the 4-hour chart. So we're looking for sell signals. We're ignoring the buy signals. It's only if the market's in an uptrend, we are only taking buy signals. But if the market 4-hour trend is in a downtrend, we are only taking sell signals. And because the 4-hour trend is in a downtrend, we're only looking at sell signals. So here, when the 10 crosses below the red or the 40, you take a sell signal, which is around here. You'd have your initial stop loss there, and you will lock in profit according to where the parabolic SAR is actually placed, and keep locking in profits. And here's a good example too, when the 10 crosses below the 40 at this point here, you'd have your initial stop loss at the first stop, which is there, and you would lock in profit accordingly based on your parabolic SAR. So your strategy needs to be so blunt that there is no room for thinking. At the minute, we've already covered how to determine if the market's in a trend. So that means when you're actually taking the trade, you don't need to think, oh, is the market trending or not? All you need to do is look at this chart here to see what trend the market is, and now you've determined a trend. You're going to trade with the trend direction. So this market's in a downtrend on the 4-hour chart, so you only take sell signals on the 5-minute chart. So your strategy needs to let you know when to take profit. We've determined when to take profit based on locking in profit with the Parabolic SAR. You're going to move your stop loss, as in modify your stop loss to each new point on the Parabolic SAR. What I mean by that is, once the dot here, you move your stop loss to there, and then move it to there, and there, and there, and there, and so on. Then it says your strategy needs to let you know when to cut losses. We've already determined that by having your initial stop loss. So I mentioned that if you was to enter the trade based on the 10 moving average crossing below the 40 moving average, which is at the point here, which is at this point here, you'd have your initial stop loss at the first Parabolic SAR, which is there, which means you've already established a cutoff point at a point that you will exit the market and take a loss. So now you've already managed risk because you know when you're going to leave the market. So your strategy needs to let you know when to cut losses. We've already covered that. Your strategy needs to let you know when to leave your profits to run. So because we've determined that we're going to trail profits with the Parabolic SAR, we're not going to cash out profit too early at this point or this point, because we're only going to lock in profits according to where the Parabolic SAR actually is. So that's going to save you a lot of time and money. So we've covered this section here. So now we've covered all 4 of these, and the last one is your strategy needs to let you know when to not enter the market and preserve capital. The way that we've done this is we have a few buy signals. Like we have a buy signal here, because you remember a buy signal is determined when the blue crosses above the red. That's a buy signal. That's a buy signal there, and that's a buy signal there. But the way that we've reduced the amount of trades that we've taken and evaded taking so many losing trades is by actually trading with the trend. So this initial thing that we used here, or that we started doing here, which says determine the market trend on the 4-hour chart with the 10 EMA and the 60 SMA, that has enabled us to determine that we're only going to trade with the market trend, so we're going to save a lot of money. So we're going to preserve capital, which is good. Preserving capital is a key thing in trading. What that means is, when it's time that you're actually losing trades, make sure you've always got a stop loss. Make sure you've allocated your risk already, so that you're only going to lose a small portion, as in the percentage risk that you've already set. And also you can save yourself a lot of time without forcing trades. So by you having a set system in place, as in this very short strategy that we just developed here, you can already reduce the amount of losing trades that you have and focus on the profitable trades. Because already, if you're in an uptrend on the 4-hour chart, then you won't be taking sell signals on the 5-minute chart on your USD based on the moving average trend following strategy. But if you are in a downtrend, you should only take downtrend opportunities on the 5-minute chart. So already you're saving yourself a lot of time and money. But we're coming to an end on the workshop now, and again, this has been a very basic workshop, but I know that a lot of people will be grateful for it, because they've asked me a lot of these questions and I've covered most of them. For the more detailed stuff, that's more strategy development, I've touched on it very briefly just now in this workshop at the end. This is very short. There's a lot more things we can add. There's a lot more ways that I can reduce the amount of losing trades. I can increase the amount of profitable trades. I can use it on a larger time frame, on a different currency pair, and I can show you all of that. But first, I hope you can enjoy this first workshop, and I hope that it answers a lot of your questions. But if you've got any more questions or would like to go ahead and learn more, then get in contact with me. And we have strategy development and strategy improvement that helps me, that allows me to help you reach a level of profitability a lot sooner and a lot quicker. But now that I know that you can watch this workshop, I know that you will be on a very high level of trading. You will no longer be a beginner. You'll know how to properly use the correct tools, and you'll know the technical terms that I'm referring to when we talk. So I hope that you can watch this workshop, get what you need to get from it, and I know that you can apply exactly what I've shown you straight away. So we've covered all of this: what is Forex trading and technical analysis, MT4 chart setup and setting up charts and templates and profiles, support and resistance, market trend, moving averages, parabolic SAR, how to enter trades, exit trades and modify trades, trend lines, key candlestick patterns and formations, briefly covered risk management, the RSI, divergence, relative strength index, MACD, moving average, convergence, divergence, Fibonacci, volume indicators, and we touched upon strategy development. Again, strategy development is a very big topic. So too is risk management. It's a very big topic also. But in this first workshop, I feel that I've covered all of the key factors in trading, and it will help you to develop a good strategy once we can sit down together and go through certain things. Also, we can cover risk management properly. But I hope this video helps, and your feedback will be appreciated. You can contact me via the email or any way that you contact me initially, email, phone, that sort of thing. So yeah, just contact us and get started. We have a proper strategy development available and proper risk management available. So I look forward to hearing back from you.